All right, everything looking good. Should be live. Let's go ahead and get this party started. Welcome back to the channel, Crypto Trend Trader, with our midweek market update. It is Wednesday, January 12th, 2022, 8 p.m. Eastern Standard Time. Before we get started, I'd like to remind you this is not financial advice. I'm not your financial advisor. These markets are extremely volatile, so please do your own research and trade responsibly. All right, so we got quite a bit to look at. Obviously, our Fed minutes came out, and Jerome Powell, went before Congress for the little love fest. And they discussed some important things about inflation. And then, obviously, he is going to be reappointed as the Fed chair. And then, obviously, today we got the big number, the old CPI. So we got plenty to talk about. So as we discussed, as I expected, predicted, whatever you want to say, Powell was basically a hawk in dove's clothing. So he was basically just waiting to get, re-nominated by Biden so he could get reappointed. And then as soon as he was, re-nominated, he basically has been talking hawkish since then. So I find it hard to believe that Powell, didn't realize what was going on, didn't see inflation starting to pick up, didn't know that, Fed and basically fiscal and monetary policy had to do with what was going on. He's not dumb. He might play dumb. He's really good at acting dumb, but he's not dumb. He's like your dog when you catch it doing something it's not supposed to do. It acts like it doesn't know what's going on, but let's be real here. It knows it ate the cheeseburger you left sitting on the table. It knows it was tearing through the garbage. It knows why you're mad. That's Powell. He's just acting dumb. So, and that's fine. That's part of his job. All government, their job is to just act fucking dumb and basically extort money from the people. So he's doing his job. He's doing a good job at it, So anyway, we will get into our normal technical analysis, but one of the group members asked me to discuss a couple of things. And it's obviously relevant too with our new data and everything. So we're going to go ahead and take a look at that. So essentially the topic of our little discussion here to get started fits in with everything going on, and hopefully will help everybody to gain a better understanding of what's going on, but also a macro outlook and how this is going to play out in the markets so that we can position ourselves so that, one, we don't lose money, and two, that we can profit from what's about to happen or what is already in motion or about to become in motion. So in order to understand the whole picture, we have to focus on, there's a bunch of different moving parts, but the main parts we want to focus on right now are the CPI, which is, basically the inflation as measured by, the Fed or Federal Reserve economic data. Then we want to look at the Fed funds rate, which is essentially the interest rate that the Federal Reserve sets for banking institutions to borrow money or loan money to and from each other in the overnight repo markets. And then that is directly tied to the actual interest rate of the yields on the various treasury bonds that are set when they're issued. And then the duration of the bond itself determines where it is in relation to that. And then the longer the time frame, theoretically, the higher the duration, the more the rate should be. Because if I borrow, $100 from you and I tell you I'm going to pay you back tomorrow, if you're willing to give me that loan, probably not much is going to change between today and tomorrow. So the likelihood that I can give it back to you and you can just, pay me an extra dollar back or whatever, or I can pay you an extra dollar back, whoever borrows the money, is pretty likely. But if I loan you that money for a year, a lot can change in a year. So you want a little bit more money, before you get your principal back. And then, the longer duration, if I loan you money for 30 years, a lot can change in the meantime. Not to mention, there's different factors. Maybe, you die. Maybe you make some bad investments. Maybe inflation goes through the roof. There's just a lot more factors. So you would expect to get more money. So that is why we pay attention to the various treasuries and, the yield curve on those, or like the overall yield on those relation to each other. And then that's how we get the actual yield curve, and then pay attention to yield curve inversion. And then on top of that, we have the US dollar and how it is reacting to all this, which essentially is just the DXY is what we look at for that. So it's telling us the strength of the dollar in relationship to a basket of foreign currencies, but theoretically representing, the strength of the dollar, the world reserve currency, in relation to, everything, basically. Although it only measures it in certain currencies, gives us a broad outlook on the dollar in relation to like foreign currencies, to tell us where other people are likely to put their money, and where, if you're not inside the United States, and if you are inside the United States, where you would rather put your money, whether you want to invest in domestic or foreign assets or markets. And then on top of that, we can see not only how the treasuries and the yields correspond, the DXY or dollar strength and weakness corresponds, but then also we're going to look at the Dow Jones, how it reacts. And then, of course, we're going to pay attention to energy as well. So we'll look at, oil basically as, it is essentially, the way we look at it, and I discuss this all the time, oil is essentially the cost of, creation, the cost of creating things or building things, making things, moving things. It's the cost associated with actual like manufacturing and transportation, so it's basically the cost of doing business. No matter what your business is, depending what it is, it might be influenced more or less, but overall it's always going to be influenced. And then on top of that, we have finally the yield itself, which is essentially the cost of money. So, if $100 is free, there's no yield associated with it. If you have to pay a 1% annual interest rate or, 10% annual interest rate, you're more or less likely to borrow or loan money based on that yield that you're getting on it. So if you have a basic understanding of all those things, that's a start. That's a foundation for everything else to be laid out on top of it. But now we need to understand how they correspond with each other, the relationship between them in different environments, and then what's going to end up happening, what happened, and why this time is different. Because everybody says, well, they can't raise rates. There's no way. It will bankrupt the economy. It will crash the stock market. The U.S. will default on its debt, and it will crash the whole world economy, and they'll lose reserve currency status. Therefore, all those things have to be true 100%. That's everyone else's argument. Because all those things have to be true 100%, therefore, we will in fact see inflation. They won't be able to fight the inflation, and it will get out of control. Everything will crash. Therefore, spend all your money as fast as you can. Buy as many goods as you can, because they're only going to cost more in the future. And find anything you possibly can that's an inflation hedge, whether it is gold or other precious metals, whether it is real estate or property, whether it is Bitcoin or cryptocurrencies. But whatever you do, don't keep cash, because it's going to go to zero. That's the argument. That's the mainstream narrative. That's the same narrative that 99.9% of people have been pitching and swearing up and down and saying this is a fact, it's factual, and they've been presenting all of them the exact same data. But they're missing one key point, the most important point, the most obvious point, the clearest, most easy for even a child to pick out point in existence. And I'm going to point that out to you. And then afterwards, it's going to be very clear why everyone is wrong. Why everyone is wrong. Why Jerome Powell is going to raise rates. He is going to fight inflation. He is going to crash the markets intentionally, because that's what it takes to stop the inflation, and how that's their plan, and they're okay with it. And it's going to be painful for sure. But if you understand their directive, if you understand their objective, their motivation, what they want, it should be very clear to everyone that the central planners, the governments around the world, the politicians, the elites, the 1%, the 0.1%, they're on a power grab right now. Over these last 2 years, they have quote unquote, like the old saying goes, don't ever let a good crisis go to waste. It's very obvious now that this situation is not as serious as we initially thought it might be. I'm not saying it's not serious. I'm not saying that I don't believe in it. I'm not saying that people haven't died. But in hindsight, if we were to look back knowing what we know now, I think the situation would have been handled differently. I think everyone could argue that the situation would have been handled differently. We wouldn't have just shut down the whole world. We wouldn't have just closed everything down, crashed the world economies, printed, or however you want to look at it, money, done all these different things, quantitative easing, all kinds of different stuff, all these things, basically changing the whole world and central planning everything, giving up ridiculous amounts of freedoms, rights, etc. There's all kinds of countries that have ridiculous things happening right now. We have all but shut down on multiple occasions, world travel, even travel, within like borders of countries that are literally touching each other. I mean, it's very clear that the elites use this opportunity, whether it was intentional or not to begin with, as a power grab. And we all know that the same way that 9/11 was turned into a power grab, and from that point, there was fear mongering and everybody was afraid on airplanes of a terror attack, and now we need TSA to search your shoes and pat you down and x-ray you, and yet they've never stopped anyone. I mean, I'm not even going to get into all that, but essentially it's just rights we gave up. And then on top of that, they created various programs or objectives that allow them to essentially monitor citizens' phone lines, internet, emails, etc., without their permission, if they were considered to be a potential threat. So basically just more rights taken away, but, for our safety, for our protection. And now we're seeing that all over the world now, and how this is all tied together into a big narrative. And it's not a conspiracy theory, it's a fact. We've all seen all those things happen over time. But when you put the big picture together and then you realize why everybody is wrong, it makes a lot more sense. So let's dive into it, and then we're going to circle all the way back to what I just said about this being a giant power grab. Because everybody thinks that the rich get richer and there's this giant transfer of wealth going on, and Jeff Bezos and Elon Musk and all the billionaires made so much more money, and all the poor people got poorer, and all the middle class people got poorer. And meanwhile, we all gave up our rights. And this is horrible, and we have to stop it. So we need more central planning to fix it. We need to do this, that, and the other to fix it. But in all actuality, all the things that people are asking for is what's making it worse. The Federal Reserve, the central banks, they're what's creating this wealth inequality effect, this trickle-down effect that doesn't work. So the same thing that happened in the Great Depression, everybody gets rich together on paper, and then the crash happens in the stock markets, everybody loses everything, but then all of a sudden the billionaires, the rich people, they swoop in and buy everything at the bottom, and then they end up owning everything, and that's when the true accumulation, that's when the true wealth shift happens. That's when the true power shift happens. That's when the people are willing to give up anything and everything, their rights, people were literally selling their children for food so that they could feed themselves and the rest of their family. You can, if you don't believe me, read up about the Great Depression, read into it. So if you don't understand that what we're seeing now is not the actual power grab, this is not the wealth shift. That happens when everything crashes. The real money is made in the crashes. That is when the actual shift takes place. So when everyone says they can't crash the markets, they won't crash the markets, they can't fight inflation, they can't raise interest rates, sure, they can't unless, that's what they need to say. They can't raise interest rates to fight inflation unless they're willing to crash the markets. They can't do this unless that's their objective, unless that's their goal, unless they can't do all these things and make everybody suffer and struggle and food shortages and unaffordable housing, unless that's what they want. because then we will beg them to step in. We will beg them to give us what we need to survive, and we will be willing to sacrifice anything. Oh, you give up your rights for, a welfare little food stamp card or whatever so that you can feed your kids? Of course, take my rights. Oh, of course you can monitor my bank account. Of course I'll take your Fed coin. Of course I'll take your central bank digital currency. Oh, thank God, I can't find a job and I can't feed my kids without it, and I need this. And now you can monitor every transaction that I do. Now that you can track me wherever I go, you know exactly what I'm buying. You have the ability to put negative interest rates or expiration dates on the funds, and I'm completely reliant on you now. So if I do something outside of the social system of what you want me to do now, you can cut off my card or arrest me because I, agreed to these certain criteria by accepting said Fed coin or whatever. I mean, it's all central planning and control. So to sit here and say that they can't do this because of that is wrong. It's ignorant. To even think that you know the objective, especially when they have literally come out and told us what the objective is. The objective is for you to own nothing and be happy. They told us that. They literally came out and said it. So let's take a look at how this lines up. And, now we have the overall broad picture. Now I'm going to explain essentially how we get there and how this is their objective the entire time and how it's happened in the past and why this time is completely different. Exactly. Crypto Deli, the Great Reset. That's exactly what it is. They literally came out and told us the Great Reset. And you can look back through history and see it has happened over and over and over again. It's part of central planning. It's part of, a ruling elite class that thinks or knows that they have our best interest in our minds, because we're just uneducated, stupid plebs. We rely on them, and without them, we will be useless, and we need them. So now let's look at how it all lines up and what all this means, and then why everybody is so wrong about them not being able to raise rates. It literally makes no sense. So let's start off with the actual, so each of these charts right now that I have pulled up, I have the regular TNX chart on the monthly going back to basically like 1985 to present. And then I have DXY chart, which is the dollar index, going back from like 1985 to present. And then I have the Federal Reserve Fed funds effective rate from 1985 to present. And then under that, I have the CPI from 1985 to present. And the reason we're using 85 to present is because some of the data only goes back that far. Otherwise, I would just go back to like the 1900s if we could. And then I also have the Dow Jones chart lined up the same way that I'm going to pull up. And then I also have oil as well. So we can see how these charts correspond with each other, how the various peaks correspond with each other, and the relationship between one, causation, and two, correlation. So how are these different periods in time, these peaks and troughs, correlated? And then which ones are causing the other ones? So when we hear things like inflation is raging out of control, we need to raise rates to combat inflation. We know that the cause is the inflation is out of control, and the effect is that we need to raise rates to combat it. So regardless of what caused the inflation to begin with, we know that the effect is they're going to raise rates to fight the inflation. And like there's all different various things. So we know like the leading indicators for a crash in, say, the stock market, for instance, is energy prices spiking through the roof. Because eventually when things get too expensive for people to produce, they can no longer produce those goods efficiently. Therefore, demand falls off a cliff, and the cure for higher prices is higher prices. And then therefore, everything crashes. And the same way with the money. If the funds rate goes up too high, or the interest rate that you have to pay to borrow money to, essentially create businesses or manufacture goods or provide services, if that goes up too high in the same way, eventually people will stop doing it, and then we'll essentially have like that same type of crash. So all these things correlate with each other. Some are the cause, some are the effect. But if we look at them all together and the relationship between them, we get a much broader, better understanding of what's taking place. So let's start here with the Fed. Can you guys still hear me? Am I coming through? I had just a little issue with OBS. It says it's reconnected, so we should be good to go. But anyway, So let's look at the Fed funds rate first. So again, we're going back to like 1985. We see these little gray periods right here where, okay, thank you, Ty. We see these gray periods right here. Each of these is a recession. So whenever it's highlighted gray in the background here, and I have these purposefully lined up so the recessions line up with the charts, and then we can look at like the peaks and troughs. Thank you as well, Crypto Deli. So we see basically that what was happening here. So essentially, we have the Fed funds rate at like the highest level ever before this. This was when Paul Volcker had to raise rates to like ridiculous levels to combat, inflation. He raised like the rates to like 20% to fight the inflation. Since that period of time, since the 80s, we've been in a perpetual downtrend. So every single one of these peaks has been lower than the previous peak. And then we see each time we had a peak in this, more often than not, it was followed by a recession shortly afterwards. So we don't see one taking place right here, but only because if this chart went back a little further, we would see that there was already a giant peak when inflation was crushed by Volcker, and then we went into recession. So the recession actually just already happened off the page here. So then we see each peak after that. This one here was in 89, and then we went into a recession in 90. So rates went too high for whatever reason, doesn't matter. The rates went very high, and then we ended up in a recession because rates were too high. So then here we see once again in 2000, the rates went to another high, higher than they had been any other time except for right before we went in the last recession. And this time they went up to about 6.5%, and then we went into a recession. And each time we have a lower low as well for the rates, because after we went into a recession, they lowered the rates to essentially like get us back out of the recession. Because in order to get people to borrow money and create businesses and spend money and stimulate the economy, you have to make money as cheap as possible so people are more likely to take it and then do positive things with it, therefore get us back out of the recession. So that was in 2000. So again, we crashed to a lower low. And then again, after that, we come back up to a new high. That was 2007. 2007, this time we only get up to about 5.25. And then again, we go into recession. And then this time we, effectively come back down to zero. 0.16, 0.15, 0.9, 0.8. And then again, 2019, we all know what happened then. Powell was on autopilot, raising rates back up. 2019, we get back up to about, 2.4 on the Fed funds rate. And then, of course, everything crashes. We know what happened with that. Obviously it was tied specifically to, the sickness heard around the world. Was that the reason that everything crashed? Was it going to crash anyway? Was it not letting a crisis go to waste? Was it planned? Was it intentional? I mean, you can speculate on those things as much as you want. But what we do know is that every single time the Fed funds rate went to a lower high, the economy could not take it anymore, and therefore it went down first. It started going down first, and then we ended up in a recession regardless. Because we see it always peaks out and starts going down because they're trying to stop whatever bad is happening, and then we end up in a recession. Going too high, the markets can't take it. Go down to try to stop, we end up in a recession. Markets can't take it, we go down. They try to stop it by lowering the rates again, and then we end up in a recession. So we know that, regardless of what the cause is, we know what the effect is. Every time rates get too high, they have to drop the rates down to a new low. Each time they raise the rates, it ends up at a lower high, and then each time we end up in recession regardless. Those are all factual statements. We don't have to speculate on anything. That's all 100% factual. So that's the effect of the Fed funds rate and what ends up happening. So we know that we've been in a perpetual downtrend in the Fed funds rate, and then it cannot make higher highs because every time the Fed has to lower it because other things are happening that are not good. And then we eventually end up in a recession anyway. So what are those other things? Why is the Fed deciding they can't raise rates any higher? What is the negative or the catalyst? What is the effect that's happening every time the rates start to go back up that they say, whoa, we can't do this anymore. We have to back these rates back down, or else X is happening, or else this bad event is happening, or else something terrible is happening. So let's go ahead and we can look at some of these other charts and see what well, you know what? We're going to still go our charts in order, but I'm going to give you a little prequel, a preview, an idea of what's happening. It's the stock market crashing. Okay, that's the answer. Every time they raise the rates up too high, the stock market crashes, the real economy crashes, GDP starts to suffer because productivity goes down, because money gets too expensive. Therefore, people aren't using, borrowing, investing, spending, developing, creating. And so we're having issues. So they have to lower the rates again to basically fuel the economy back up, to fuel the stock market back up, to continue, essentially like the boom. But each time we get a lower high and a lower low. And we all know what happens eventually. If you get too many lower highs and too many lower lows, you eventually go to zero and then you flatline. And then the only two things that can happen after that is you either die or you eventually put in a higher high. So at this point in time, we know for a fact our last higher high was in 2019, or lower high, I'm sorry, and that was at 2.42%. So we know for a fact that if we put in a Fed funds rate higher than 2.42%, that we will be taking out the previous high. Therefore, we will break the downtrend. We have been in a downtrend for the last 40 years. If we go higher than 2.42% on the Fed's funds rate, we will break that downtrend. There will be a trend shift, and then we will no longer be in a downtrend. Now, does that mean that as soon as we take this out, we immediately just go to new highs? No, but it means the next area we pay attention to is the previous high before that. So if we take out 2.42%, you could reason, with intelligence, that the next area we would pay attention to will be 5.25%, because that was the previous high right before the last recession, the last big event. And obviously we know, we obviously know what was 2000, the dot-com bubble burst. What was 2007, 2008, the global financial crisis / mortgage crisis. What was 2019, the call for it around the world. So we know these all corresponded with massive, events and massive, recessions, crashes, whatever you want to call them. And then we can also look at what catalysts were taking place at the same time as well. We know this was the flu. Oh, okay. So we blame it on the flu. That's cool. We know in 2000 what happened then. Okay. Random airplanes crashing into things. Oh, okay. That seems kind of important. So we can tie some of these things together with like events as well. And whether or not that was the catalyst for them, whether or not they were going to happen anyway, it's all irrelevant. We don't need to speculate on any of that because we have the actual facts in front of us. So just continuing on down those lines, I'm going to skip over the percentage rate right now, the inflation. We're going to skip over that one because I want to draw a correlation and circle back to all this. So perpetual downtrend, okay? So now let's look at our 10-year. So again, we see going back to the 1980s, we see this has been, it entered into a bear market. I'm going to just turn this off auto for a second. We just back here in the 80s, we crossed below the 200 exponential and simple. And everybody knows on, the way I have these indicators set up, the way I do technical analysis, that once we cross under the 200 exponential and simple, in this case on the monthly, once they flip over red, we are now in a bear market. So we have been confirmed in a bear market in treasury rates, therefore in a bull market on treasury bonds for the last 40 years. So that same period of time, we were putting in, progressively lower highs and lower lows the entire time on the treasury yield was corresponding with the Fed funds rate. So why is that? Well, because essentially the Fed funds rate is like an overnight rate that the banks and, other bank entities are like trading money between each other in order to like capture money or to pay debts like on very short term basis. So whatever this number is going to be much lower than what it is on a 2-year. And then that's going to theoretically be lower than what it is on a 5-year, which is going to be lower than a 10-year, which is going to be lower than a 20-year, which is going to be lower than a 30-year. And the idea being that the longer the duration is, the more risky the loan is. Therefore, you would, it would reason that you would require a higher rate to counteract the higher risk, or else it wouldn't be beneficial to you. You would just do if it wasn't beneficial to do a 30-year and it was higher interest rate to do a 10-year, you would just take the 10-year and then you would reevaluate after the 10-year expires. And then you could just go into another 10-year, and then you could do that again 10 years later, and it would be the same as just taking one 30-year. So if you can't lock in a better rate right now on a 30-year, you're not going to do it. You're just going to go for the 10-year. So that's why we talk about essentially the flattening of the yield curve is essentially just the relationship between the short-term duration and the yield associated with it in comparison to the longer-term duration and the yield associated with it. Therefore, taking into account risk and reward, we know that if the risk is too high or the reward is not high enough, that we're not going to take that. We're not going to take that deal. Therefore, it pulls money towards the shorter end of the curve. And then we see essentially like that flattening or potentially yield curve inversion. If the long end of the curve is not paying a high enough rate, you're just nobody's going to be interested in it. Therefore, it's going to drive it down. Demand for that's going to go down. Nobody's going to want it. So then they just go to the next shorter term before that. So if the 30-year sucks and you get more money, higher percentage rate for the 20-year or the 10-year, you just go do that one and then reevaluate after the 10 years is up or whatever. And if the 10-year is no good, you go to the 5-year. And if 5 years is no good, you go to 2-year. Or even if they're all the same, you just go for the shortest duration one because there's no reason to take the extra risk, time being the factor or inflation being the factor that's eating away at your buying power over that time. So now we can see how this corresponds to it. So now let's look at those same dates that we're paying attention to. So this was 2019. Well, actually it was the end of 2018, beginning of 2019. This was the retest of the 200 exponential and simple moving average in October of 2018. And then here we can see obviously our peak right here. This was in January of 2019. So we see that this actually got rejected right around the same time and went lower. And then the previous peak before that we have is 2007. And then before that, we can go back and we can look at 2000. And then we see that each of these peaks obviously corresponds with these peaks as well, because they're essentially measuring the same thing, the cost of money, borrowing or loaning money, and the benefit or cost associated with it. And then we know that the bond chart is going to be the opposite of this, because the way the bonds are calculated is, the preset amount when the bond is issued of interest is essentially like the rate that you're going to get on interest for that bond throughout the duration. So if I buy a bond for $100 and it's a 1% interest rate, I'm going to get paid 1% per year times the duration of that bond. So if it's a 10-year bond, I will get 1% per year for 10 years. At the end of the 10 years, the bond matures. I turn it back in. I get back my $100, plus I made $1 per year in interest. So now at the end, I loaned you $100, you being the government, and then I get back $110 when it's all said and done. But I get the $1 along the way through like the actual coupon or coupon rate that's associated with it. Now, the reason that the rate itself fluctuates on those bonds is because the bond market is actually like a free market where those treasuries trade back and forth. So essentially now somebody could buy that bond initially for $100 and it has a 1% yield on that bond. But let's say over time there's more demand for those bonds. Therefore, you might say to me, hey, I like that bond. I'll give you $110 for that bond. And I'm like, wow, that's a great deal. I only paid $100 for the bond. So maybe I sell you that bond now. So now the interest rate stays the same. You still only get $1 per year for the remaining duration. And then at the end, you still get back your $100 when the bond matures. But the difference is that now because I paid $100 for it and it was a 1% rate on it, you paid $110 for it. So now if you recalculate the purchase price of that bond at 110 and you know that it was 1% of 100, you're actually not getting a full 1% because you paid more for the bond. So you're still getting that same dollar, but percentage wise, that dollar, because you paid 110, is really only like 0.9%. It's not a full 1% because the purchase price was higher. So as the price of the bond goes up, the yield in relation to the purchase price goes down, and vice versa. As the price of a bond, if nobody wants them and they're going down, the percentage that you're getting is going up. And here's a perfect example of that, and then we're going to move on again. If anybody has any questions along the way, I will periodically glance over and make sure that I am like clarifying this. If any of this is too basic for you, just bear with me. I'm trying to give like a super thorough idea so that everybody can truly understand the big picture and how all these things correlate. And if you're missing even one small portion of it, or you learn just one thing from this, it will exponentially benefit you in the long run, and your full-on understanding of all these things. So a perfect example is Evergrande. Everyone's familiar with Evergrande, the property company in China. You know, they were crashing, their prices like went horribly low. So essentially the difference between a bond from a government versus a bond from a company is, you know, essentially just it's more risky because you don't know. You know, likely a government is still going to exist at the end of that period. So more likely than not, you're going to get your money back. Now, is that always the case? No, of course not. Like some country bonds are riskier than others, you know, and they're rated based on that by like, you know, AAA or D or whatever. So, you know, essentially some are more risky than others are. So if we look at, obviously United States treasuries are very low risk. So people like them because they know, hey, there's a really high likelihood based on the past, because they have never defaulted on a treasury before. If I loan them my money, I'm going to eventually get my money back plus the interest rate. Even if it's not a great interest rate, at least I for sure know my money is safe. So if I need somewhere safe to put my money and I want to get a little something for it along the way, but with almost no risk, that's the place to go. Now, Evergrande, for instance, obviously had a bunch of issues. The stock price is crashing. They're not able to deliver the properties they were supposed to. They have an EV branch that's going under. It's basically looking like a giant Ponzi scheme. They were using the money from the new people to try to finish the buildings for the old people. And now all these people are owed houses and the company's bankrupt. They don't have any money. And it's super freaking risky right now. So the bond prices have completely crashed. So if you were going to buy that bond before for $100 when it was issued and it had, say, a 10-year duration at 1%, now it's super freaking risky. So people just want to get rid of these bonds. They don't trust. They don't want to wait the rest of the duration to get back their $100. So if it looks super shady, like this place might go away, I might just say, hey, you know what? I don't want to take the risk. I will sell you this bond that's good for $100 in whatever, 5 years from now. And I'll sell it to you for $50 because I just want out. I need that money back. I need to get my money back, need to recoup what I can, and I just got to get out. I can't risk it. It's too shady, whatever. So then as people are just selling off all these bonds because there's all this bad news and they're afraid they're not going to get their money back, it crashes the price of the bonds. So what does that do to the rate? Well, if I paid $100 for the bond and it had a 1% coupon rate, you know, essentially I was getting $1 per year on that $100. Now, all of a sudden, if you pay $50 for it and you're still getting that same 1% on the purchase price, you technically paid $50 for it. So if you're getting $1 every year, you're actually getting 2% because you only have $50 invested. So now, you know, technically that same $1 is 2% of your initial investment. So you could buy 2 of those bonds for the same amount and get $1 for each per year until they mature. And then at the end, you still get back the $100 because you're paying for that extra risk associated with it. So in the case of like Evergrande, you know, the bonds went from say $100 down to $5. So now it's exponential. Instead of now you're getting, you know, in the $50 example, instead of the $100, you're getting 2%. Now they're $5. So you're basically getting 20% because now you're paying $5 for this bond and then you're getting $1 every year because that was the initial rate associated with the bond and you just paid like basically nothing for it. So you can now go out and buy 20 of those. You have the same $100 invested and each of those 20 bonds is paying you $1 per year. So you're making a 20% interest rate. And then at the end of the duration, the maturity of those bonds, you would get back the full $100 that you have invested, assuming that the company still exists, assuming that there is still someone to say, hey, I would like to turn in these bonds now and get back my principal. And it's like, oh, there's no such thing as Evergrande anymore. So good luck. And also obviously assuming that you're going to get your payments along the way. So that is how the price you pay for the bond affects the rate of it. So when we look at something like TLT chart, which is the 20-year treasury bond price, we can see on that chart what the yield is basically, or we can see what the price is and then we can calculate the yield. So when we look at the TNX, that's a 10-year treasury, and we're looking at the percentage that pays you, as where when we look at like the TLT, that's the 20-year treasury bond, that tells us the price of the bond, and then we can calculate what the actual percentage it's paid is. So they're basically just the two sides of the same coin. Like one is 10-year, one's a 20-year, but one is looking at the percentage rate and the other is looking at the actual price that you could buy or sell it for. And that's how it's relation to the fixed price when the bond is issued, the fixed rate when the bond is issued, but then the actual market itself is determining the overall price and then like the real yield based on the price you pay, not taking into account like your net profit or loss based on the actual inflation rate. So we're not even going to talk about that right now because that's a whole different thing. Because, essentially if you take out, just to touch on it, if you get a 1% interest rate for 1 year, and inflation is 10%, sure, you loaned $100 and then you got back $1. So now you have $101. But through inflation, what you would have been able to buy at the beginning of the year for $100 now costs $110 because your buying power of your currency has been eroded. So now to buy, if you wanted to buy, a widget at the beginning of the year, but you decided to invest in a bond instead, and you said, well, I'll just buy it at the end of the year. And then at the end of the year, the widget now costs $110. You have your $100 plus your $1 interest. So now you're still $9 short to buy that same widget. So you're like, oh man. So sure, you got a 1% yield, but interest was 10%. So in all actuality, it was like a negative 9% real yield because you're taking into account inflation versus your actual interest rate. All right, so now we have those laid out. We understand the importance of them. We understand the relationship to the actual bond purchase price, the interest rate, and how that all corresponds with the Fed funds rate, as well as the actual difference between like a federally issued and backed, like treasury bond in a reliable country that's never defaulted versus one in something that's super risky, a company that's basically in the middle of defaulting or potentially going bankrupt. And how basically like the difference between, a treasury and a junk bond is what you often hear people refer to them as. And the junk rating is basically determined by how risky it is. So, okay. So now let's look at the DXY. So we have the DXY once again with a high back here in the 80s and then dropping down, to basically put in a low in the 90s, 92. And then we have once again a high right around here in 2000. And then again, we have a low down here in 2008. And then again, we have, obviously a high right around here in 2016/2020. Well, yeah, basically March 2020, and then obviously where we're at right now. So we can see basically that this peak right here, this macro peak in like 2000, again, corresponds with the 2000 dot-com bubble burst. And then we see once again that the next peak down here, basically was 2005, but when this goes down here to the bottom, that corresponds with 2008. So here we have a macro peak and we have a macro trough, and one corresponds with the top right here in like the 2000 dot-com bubble burst, and the other corresponds with the 2008 like crash. So these sometimes do not act the same way as the other ones. These other peaks that we saw with the interest rates and relationship to each other were all like a peak at the same time. But with the dollar, we see that's not always the case because this is taking into account not only like risk in the stock market or investments or in treasuries, but it's taking into account different risk as well because it has a currency factor to it, which is now turning that international. So when we look at the Fed funds rate and we look at the U.S. treasuries, those are completely based on what's happening in the United States. And there's no real bearing. Like there's outside forces that might determine who else is interested in them, but they don't give us any relationship to what's going on like internationally around the world, anything like that. This, however, takes into account what's going on. So because here was the dot-com bubble burst, that was a United States thing. That was a tech bubble. That was happening here in the United States. And there was backlash around the world for it because other people, foreign investments, were in the United States. But this, the global financial crisis, that was global. That was obviously going all over the place. So that had a different effect. It didn't end up as a peak in the same way when the dollar would strengthen because everybody's fleeing from all these other assets. In this case, we didn't see that same thing happen. We actually see the dollar weakening in that period. So this can tell us something different, but is still correlated with the peaks and troughs, just not always directly correlated. Sometimes it's inversely correlated. So this gives us basically like the global picture, and then we can get some things from that we wouldn't normally be able to get. So what's important about this chart though, and the reason we're looking at it, is not only for that, but again, we've been in a perpetual downtrend since the 1980s. And we know, once again, the same way when this flipped into a bear market, when we went under the 200 exponential and simple, we know the dollar now on the monthly has flipped into a bull market because it's now on top of the 200 exponential and simple, and they both have a slope angled to the upside. So again, now we're seeing a macro shift. The same way this shifted into a bear market that then lasted for, 30 plus years, we see that the dollar was in a bear market for 30 plus years and has now shifted into a bull market. So something is telling us, based on the DXY, based on the dollar, based on what's going on globally right now, that where we want to put our money, where we want to invest, where we want to go for safety or for profit or whatever it is that the whole world is seeing, we know that people want the world reserve currency. Even if it's because the world reserve currency is going to go away. It's going to crash. It's going to be gone forever. But before it goes away, you have to settle your debt. And when you settle your debts, you settle them in dollars. And a lot of the dollar denominated debt around the world is not actually issued by the United States. So when people say, well, people will just say, F you, United States, we're not going to pay you back your money. And then the United States will just try to go to war with us and they can't fight everyone. Well, that's not how it works, because you have countries like China issuing debt in dollars. You have countries all over the world, all over Europe, all over Asia, all over everywhere, that are issuing debt to and from each other using what's called the euro dollar system, with no dollars of their own, just saying, hey, I'm going to denominate this debt, I'm going to denominate this loan in dollars. So when you have to pay me back, instead of paying me back in Deutschmarks or, euros, you just pay me back in dollars. And people, why would they want to do that? Why would somebody not use their own currency? Well, because the dollar has been in a downtrend for the last 40 years. So if I borrow money from you in a depreciating currency, well, based on the last 40 years, chances are, if that trend continues, I'm going to get to pay it back to you with a less valuable dollar. So if we know that the same way inflation, hurts our buying power over time, because our dollars or our currency is worth less in the future because it's being inflated away, the value of it is going down over time. Therefore, if we pay back a fixed amount in the future, but the fixed amount has less buying power, we're benefiting because we're paying you back essentially with less. It's still the same amount, but it's less buying power. So when people see the dollar has been in a downtrend and is, potentially going to go to zero because everybody hates it and they're devaluing it and it's garbage and it's not fair what the U.S. is doing. They're exporting dollars and importing goods. Sure. So everybody says, sure, I'll take that loan in dollars because the dollar is always going down. So when I go to pay you back, I'm going to owe you less dollars. That's perfect. So it's win-win. And a matter of fact, I might even be able to benefit from that over a long enough duration, because the buying power or the value of those dollars is going to be so low that it's basically like free money. So sure, I'll do that. I'll take it in dollars. So you're taking on not only the time risk, the interest rate associated with the loan risk, but now you're adding into the picture, basically like foreign exchange as well, or like Forex, like you're adding another factor into it, because now you're not denominating that loan in your country's currency or the currency that you make at your job or in your investments. You're denominating in dollars. So you have to take whatever money you make at your job or at your investment or, however your income source is, and then you then trade that currency of your own into dollars, and then you turn around and take those dollars and you pay back the loan. So if every time, normally, theoretically, based on the history of this chart, every time you went to exchange for more for dollars, you took your $100, let's say it was in euros, let's say. So you took your 100 euros, and let's say the exchange rate was 1.25. So you would take your 100 euros and say, I would like dollars. And then the bank would give you 125 euros back, dollars back rather. And then you would take that $125 and you would go pay your loan payment or whatever, and that would be like your payment done. So if the dollar is continually going down, and then let's say the next time you go to make that payment, now the exchange rate is 100 euros equals $150. Now you go and you give them that same 100 euros you did last time, but this time you get 150. So then when you go pay down that loan, you're paying down additional buying power because of the depreciation of the dollar in relation to your currency. So that is the theory. That's why people want dollar denominated debt, because they're basically saying, oh, that's a bonus because the dollar always goes down. So I'll take my loan in dollars instead of in euros. So where the problem comes is when that's not the case, when all of a sudden the trend changes. And now those debts that you took on, whether they were short-term, medium-term, long-term, 1 year, 2 year, 5 year, 10 year, 30-year loans, now the opposite is happening. That same benefit that you were gaining from your currency strengthening in relation to the dollar is now being negated, and now it's going the other way. So now you go and you give them your 100, and these numbers are made up. The euro is not $150, et cetera. I'm just using easy, nice round numbers. Now you go and you give them your 100 euros. And last time you got $125 or $150 for it, and then you went and paid your loan payment. This time maybe you only get 100, and it's an even swap. And you say, oh, this is not good. It was supposed to be 125 or 150. And now it's even swap. That's not good. So you go and you pay your payment, and then you come back, to pay your next payment a year later or whatever. And now you give them your 100 euros, and they give you back $75. And you go, oh, wait, no, because my payment, I need at least 100. And you say, okay, great. Well, you got to give us more euros. So now that risk has turned the other way around on you. And now what do you want to do? Well, if now you're depreciating the same way that the duration, the time, and the depreciation of the dollar in relation to your own currency was a benefit before, now all of a sudden the time and the value difference or depreciation of your own currency is now like a threat against you. It's like a ticking time bomb, because you don't know what next time when you go back to get it, you might only get $50. You might only get $25. That's what happened in Turkey. Their currency crashed so bad now that when they go to exchange it for dollars, they have to give them 1,000 to 1, as where before it was just 100 to 1, or it was 50 to 1, or it was 20 to 1. And that's one currency crashing in relation to another. So what's happening right now is, and what the real risk is to the global economy with the DXY, is with the dollar strengthening and all this dollar denominated debt. It's not like these people can just say, F you, America, we're not going to pay you back your dollars. They didn't borrow all this money from America. They borrowed it from their own entities in their own countries throughout Europe and Asia and all these other places using the euro-dollar system. So these loans are still to the same entity all around the world, whoever it may be, but they're just denominated in dollars because at the time it was beneficial and people took that extra risk assuming that it was going to be a benefit. But now that's not necessarily the case. Now that the dollar is going into a bull market, that's actually a risk now. So the same way that it was better to have a long duration loan that was denominated in dollars, because as you paid it down, you had to pay it with less and less of your own currency because the dollar was getting weaker and weaker in relation to it. Now it's the opposite. The dollar is strengthening. So therefore, when you go to pay it back, you're having to give them more of your own currency. So now that same time that was a benefit before is actually now, it's a risk because you might have to pay even more in the future. Therefore, what do you want to do? You want to settle that debt as quickly as you can. You want to pay that down as quickly as you can because you're afraid it's going to end up costing you too much in the future. So that is why the theory of the dollar squeeze is a serious issue. If the dollar continues to go into a bull market and strengthen in comparison to these other countries, it's not that they can just say, hey, we're not paying you back, United States. It's that the entities that issued these loans around the world in dollars are the ones who's going to get more dollars back. So that is why there's an extra risk associated with this. And the euro dollar system is so risky now all of a sudden because this trend that's been going on for 40 years is starting to reverse. So we saw the interest rate trend has been going down consistently for 40 years. We saw the dollar strength trend in relationship to other countries and currencies has been going down for 40 years. And now we see that trend starting to reverse. That trend has technically reversed. It is now technically in a monthly bull market. So if you have debts denominated in dollars and you don't live in the United States or somewhere where you're getting paid in dollars, things are going to start looking risky to you if you're looking at this and understanding it, that is. So therefore, you're going to start paying attention and think, oh man, I should probably get these dollars as soon as possible. Maybe I need to go take a loan out from my bank or one of my assets, or sell some stuff I have in my own currency and then trade those in at the bank for dollars, and then go ahead and pay down this dollar denominated debt. So that causes demand for dollars, because people say, whoa, 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 the dollar's going up. It's getting more expensive and I owe back dollars. I better go get these dollars. I better pay this loan off, and then I can, go about my business. It was a bad bet, or I just need to get out of it. I don't want to take the extra risk anymore because now it's looking shady. So now everybody wants these dollars all of a sudden to pay down the debt as it strengthens. And that is literally what a short squeeze is. We saw it happen in like useless, valueless things like GameStop and AMC. And what happened with them? They were worth nothing. They were literally worth a couple dollars and were going bankrupt. And these are, useless companies that are essentially obsolete. And then all of a sudden what happened, people had borrowed shares in these companies and shorted them. So they go to someone who has the shares, they give them an IOU, they get the shares, they sell the shares into the open market, assuming that the price will go down. And then later on, they can just rebuy those shares lower, and then they can pocket the spread. So that's essentially all people were doing with dollars when they take on those dollar denominated debt or, euro dollar loans. So if all of a sudden this squeeze starts happening, the demand goes up, the price starts going up, the same way that GameStop or AMC started going up to $5, $10, $20, $100, everybody rushes in and the short squeeze happens. And now it causes a mania where everybody wants to get those stock because they have to get them as quickly as possible so they can settle up their debt. And that is now a massive, massive risk on the world because of all this euro dollar system and dollar denominated debt. The dollar short squeeze is a real thing, and it could literally crash the entire world economy. Because imagine if you're one of the people that needs dollars versus the other way around. Imagine you're an American citizen now. We have exported dollars because people need them around the world to settle up their debts in. But in exchange, we also had to import goods. So we exported our manufacturing so that we could import goods and therefore export the dollars for those goods. And it's part of what you have to do if you're the world reserve currency. You have to, because people need to have your currency. So we gave up our manufacturing to other countries in exchange for our status as world reserve currency, but therefore we become more dependent on everyone else because they need our dollars, we need their stuff. So arguably, whether that's fair or not, that's fine. Obviously before the United States, it was Britain. Before that, we can go back to Rome. We can go back to all these different periods in time where there's essentially like a reserve currency or like a dominant currency that people use. But the fact of the matter is it's required. So when people say the U.S. is running record trade deficits or it's not fair because the U.S. doesn't make anything, they trade worthless dollars for people's goods. Well, they have to. It's a fact. It's part of the system. It would literally not work at all if it wasn't for that, because it would cause a constant supply shock where everybody would be running to try to get the dollars to pay off any dollar denominated debt they had. So we have given up all of our manufacturing basically and become a, quote unquote service-based economy and decided that we're going to run massive trade deficits to where we import tons of goods, but we don't make anything. Therefore, we don't have anything to export. So the deficit between what we import and what we export becomes massive and constantly going up, record highs right now. But it has to happen like that, because if it doesn't happen like that, everybody needs the dollars, and then our dollar buying power goes up because there's demand for dollars. We have the dollars, so we say, well, we want more goods than we did before, and otherwise we don't want to part with our dollars, and we'll just wait. So that's what's potentially happening right now, is the same thing, a potential squeeze where everybody now is going to want the dollars. So if that makes the basically exchange rate between these other currencies' value and the dollar change, and it goes to where the dollar becomes more valuable. So therefore, if you live in another country, you need to get those dollars and you have to pay more for them so that you can get out from underneath this short squeeze as soon as possible. And then meantime, if you live in the United States and you're getting paid in dollars, or you have all these assets that are worth dollars, you then see, oh wait, all of a sudden everything is so cheap. I can buy stuff from China and it's so much cheaper than it was before. because the dollar's appreciating in relationship to these other currencies. So now what I could get before for $100, now all of a sudden it's only $75. And then maybe in the future, if this keeps going, now my $100, I only have to spend 50 of it to get the same goods. And as it goes parabolic, as the dollar goes into this short squeeze period, we potentially could see where the US is basically just buying up everybody's stuff for pennies on the dollar because everybody needs those dollars so badly. Now, is that sustainable? Is any of this sustainable? No, but we're talking about 40-year trends. So it's not unrealistic to think that we could go into, a period like this right here where we hit basically a low in 1995 and we went on a massive run till 2002. And during that time period, from the low to the high, the dollar gained 50% purchasing power. So what did cost, $100 before, now I had an extra $50 I could spend out of that 100. So if I bought $100 worth of good from, say Canada before, whether maple syrup, let's say, I buy $100 worth of syrup and they go, here's another $50 worth of syrup for free because your dollars are so great and grand and we want them. So that's the type of situation that could potentially happen. Does it mean that the dollar is going to crash the whole world and we're going to take over and we're going to get all the stuff? Does it mean it's sustainable? Does it mean it's going to go on forever? No, it does not. None of this is sustainable. But this is a 40-year trend that's been going on and it's just now flipping bullish. So we don't know, is it going to last now for 40 years? Is it going to last for 5 years? Is it going to last for 10 years? Is the dollar still going to crash, but everybody else's currency is going to crash faster? None of that matters. All that matters is we have the actual data and the facts. And what it's telling us is into the future, it sure does look like the trend has switched and the dollar is going to be more valuable. So now we understand how the Fed funds rate works and how that affects the economy and what's taking place and the cycles. Now we understand how the treasuries and, various other bonds and the rates correspond with those and how those peaks and troughs correspond as well to the different crises or situations. Now we understand the relation of the dollar, the world currency, in relation to all these other currencies and also the euro dollar system and dollar denominated debt that is not owed back to the United States. And obviously we understand how, supply and demand works, potential short squeeze, the deficits, the debts, all that stuff. So now that we have basically taken this local picture of just the United States and debt and percentage rates, and now we have made it global and we can see the effects of it like on the world. And that's super important because now what we're going to do is we're going to look at, now we see that the DXY is still putting in a lower high. It's still lower than that top was in 2000. So it's not like a super threat right now, but what we are seeing is that the trend is switching here. And we know that, this high was lower than the initial high. And this low, was lower than the previous low. So now what we would expect to happen is another lower high and then another lower low, basically. That's what the trend would look like if it kept going down. But now here we put in a high right here, but then we found support and then we put in actually a higher low again, even though this was a lower high. So what would confirm that this is actually going into an uptrend other than just the moving averages, other than just the momentum, other than just the indicators I've created? What would tell us that is basically if this price action comes up here and takes out this high, that's going to look really scary because all of a sudden it's like, whoa, wait a minute. This dollar really is going higher. This thing really is going into an uptrend. Things could get dangerous. The same way that on the Fed funds rate, if we come back up here and we take out this high at 2.4%, it's like, whoa, wait a minute. Something's different. We're breaking this trend. So then what do? You look at the previous peak and then you say, okay, that's the area to look for because if we take out that peak, then we can no longer say we have a high, then a low, then a lower high, then a lower low, then a lower high. So we need to have a lower high than this or else the dollar breaks out and the short squeeze goes crazy. But we still have plenty of room to run. If we take out this high, that's fine. As long as when the dollar goes parabolic, if the dollar goes parabolic, if the squeeze comes through, if the momentum picks up, if the trend is going bullish, which it looks like it is, we just need it to top out somewhere under 120 or else this could be literally like, I don't want to say a world ending or horrible event, but this would cause so much pain around the world for anybody with dollar denominated debt that it could be extremely dangerous to literally like not just people or entities, but like countries or like the system. So we see here, that's only a 20%, 27% move from where we're at now. And we saw here, that was a 50% move from the low to the high. And we see how much of a difference that made. So if we start to take this out and this ends up being a 30 or 40 or 50% move, it can cause some serious damage. Because anybody that remembers back in 2000, what it was like to spend your dollars all of a sudden to buy other goods along the way, it was like, oh my gosh, this is great. I get so much stuff. I'm buying everything from everywhere. And it's like, this is amazing. My buying power has never been so high. The same way that in 2008, when we went to buy anything, it was so expensive to get anything outside the United States because our buying power had been eroded so badly in relation to these other countries. So now we have all this stuff. We have all the correlation. We have all the facts, the stats, all that stuff. So do we want to bring it full circle right now? No, we're not going to look at the CPI just yet. We have two more charts to look at that are going to bring this all together now. So this is the Dow Jones. This is again on the monthly, and we're going back to 1985. And now again, what do we see on the Dow Jones? We see that the Dow Jones is completely opposite to the other charts we've been looking at. They have all been in a perpetual downtrend over time. The Dow Jones is in a perpetual uptrend over time. This is constantly becoming more valuable while rates are constantly going down, while the dollar is constantly becoming less valuable, etc. So we know here, basically, again, those key periods in time that we want to look at. So here we have in 2000, this was the dot-com bubble. The Dow Jones fell, and then peaked out down here at the low. And then again, we moved back up, put in a new high. And then this was our, global financial crisis, bubble pop, whatever, housing market crisis, whatever. And then again, we sell off. This time we actually put in a lower low. So that was scary. It looks like we're going to go into a downtrend potentially. That's like super dangerous. But we're able to recover from that through, obviously fiscal and monetary policy. And then we see right here, this was the COVID dump right here in 2019. And then again, we sold off pretty violently, but, didn't take out that low, obviously. So that was good. And now here we are at a new high right now. So we know how these points correspond once again with those same levels. So here we actually put in a lower low, but each other time we put in a higher high and continue to the upside. So again, when we look at that in relationship to, our chart over here, here we have the 2000 top, then we have the 2008 top, and then we have the 2019 top. And that corresponds with basically our top here, our higher top here, and our higher top here. So we're putting in lower highs on the rates, which is helping to fuel the move in equities to the upside. All right, so now and this is just giving us a broad index of basically like United States equities, which theoretically the Dow Jones should, theoretically I say, it should represent the overall health and value of the economy. Now, obviously it's only the largest stocks in, the index that make this up, and it doesn't take into account all your little small cap stocks or like, all the non-publicly traded companies. But this is essentially just a measure of the value of the United States and its economy, as a whole. So we see it's constantly becoming more valuable as a whole. So now let's look over at oil now. So oil, obviously, we know is, essentially, we know the same way that the treasury yield or interest rates are essentially the cost of money, the cost of borrowing money, or what you're going to get paid from someone else to loan them that money. We know that oil is essentially the cost of doing business. So if you run a factory, you might burn, coal or oil or nat gas or whatever to run heavy equipment or machinery or, one of a million other things that is required to like do business. Or maybe you transport goods via airplane or giant, boats that are moving shipping containers across the ocean, et cetera, et cetera. But essentially energy, in this case, we're looking at oil, is what's required to generate these goods that fuel the economy and allow it to like function and grow and transport goods and make goods and all that. So this is extremely important as well. So we see here, actually we need to go back. So again, we're looking at 1985 till present. So we see our first, we can see some of these older peaks. I'm kind of skipping some of the older stuff just to kind of, this is already like taking a long time, but I really want to go like thorough on this stuff. So we're going to just speed forward here, and we're going to look at the top again in 2000. So again, we have the peak in 2000 right here. And then that is, obviously .com bubble burst. We sell off. And then again, we go into a parabolic uptrend to 2008. And then that is the global financial crisis. And then we see that burst and we come back down. And then again, we come up here. But it's important to note that we do not put in a new high on oil prices here. And then eventually we sell off in 2014, come back up. We put in a lower high here in 2018. And then eventually in 2019, we have our capitulation event as people don't want to have the oil delivered because it costs money to store oil and everything was shutting down. So there was all this oil just piling up and nowhere to put it, and nobody was using it, and we didn't know how long it was going to last, etc. And then obviously the Fed and the government and the fiscal policy and monetary policy all steps in, and we eventually recover. But now what happened with oil is we took out our local low, our local high from 2019. We took out the high right before that from 2018. So now the area we're paying attention to is the high from 2014. So we see here we have a high and then a low. Then we have a lower high and a lower low. Then we have a lower high, then a lower low. So we're in a perpetual downtrend from 2008. And that's when people like Kathy Wood are saying oil is going to go to $12 a barrel, maybe $3 a barrel. Oil's useless. Everything's going to be electric. We're going to, just fuel cars with sunshine and rainbows. And we're just going to put our happy juice into them. And we don't need oil anymore. And it's dead and things are changing. And there's yield curves, fielding yield curves. Moronic, idiotic things. Because we all know that there's only two ways this can end. This either eventually, this downtrend ends and we break out to the upside, or eventually oil just dies and goes away. And if we look back at the history of energy, of oil, of fuel, we know that every single time the human race since the beginning of time and the discovery of, using fuel or food or fire or any of those things, as we learn to create energy, we never got rid of a previous source of energy when we discovered something new. We always added onto it, and it increased our productivity over time. So when you had way back in the day before man had fire, they would have to, man and woman, people, before they had fire. I know I'm not normally politically correct, but this could be important for any of they out there that need to hear this. Before we had actual way to cook and store food, all people did was they just ran out, hunted, tried to get enough food so that they could not die, so they could go to bed that night, feed their kids, and then wake up the next day and do it again. They had no way to preserve food, had no way to, become more productive because everybody had to go to work all the time to get food so they didn't die. And then eventually, they had berries and hunting and all that stuff. And then finally they discover fire, and now they're able to cook that food, and now they can more energy can be stored in a smaller amount because they can basically cure things like essentially beef jerky, or salt and cure them so they last longer, or essentially create the ability to be more functional using the energy of fire. Not to mention they were able to use it for various other things as well. And then as we evolved and became better, now we were able to branch out into different things, so we don't all just have to go hunt every day to keep our kids and our wife or whatever alive. So now, obviously we then discovered things like farming, and we're able to use, fire to create useful things like metals, and we're able to flourish as a race. And then eventually we discovered the internal combustion engine, and now we're able to move ourselves and goods around the country on trains powered by coal, and we become more and more productive as a society. But we never stop using previous forms of energy we discovered. Once we discover nuclear, we don't just stop using coal. Once we discover solar, we don't just stop using coal. So we see eventually that the price can go down for a while, but eventually we're going to break out of that trend because it's not going to go away. It's not going to die. It's not going to become obsolete. Maybe one day it will, but probably not anytime soon, because we don't have battery technology. We don't have nuclear fission. We don't have some sort of sustainable way to get rid of the coal, because we need to use the coal to mine the stuff that does the other things. So yes, nuclear is great, But what do we use to dig up all this nuclear power? Well, we use oil. So we use these big old machinery to dig up, the uranium, and then we manufacture the uranium and process it using, coal, oil, and then we use that to fuel these nuclear power plants to generate the power that allows us to build solar panels or windmills or all this other stuff. So they're all dependent on each other. So we know oil is not going to go away. So now that this oil chart has taken out the high right here, now the key area to look at is our previous set of highs right here through like that 2012, 2014 period. But the macro high we're paying attention to was the top in 2008. So now we see, once again, we see something has changed here. It broke trend. So oil has broken trend and is now back above the 200 exponential and simple moving average and back in a bull market. We see, and threatening, it already took out its previous low right, or its previous high right here and broke the downtrend. So now we're going to potentially threaten that 100 to 110 range, somewhere around then, and potentially be putting in another higher high off of the lows. We know that the dollar is potentially switching into a macro uptrend. So in order for the dollar to do the same thing, what would happen? Well, we would take out this high right here at like 103. And then it's like, wait a minute, now the dollar's in a bull market and taking out that previous lower high. So then we have to worry about it threatening the top from back here in 2001, or not necessarily worry, but look at it. So now we know, obviously, Dow Jones is still parabolically moving to the upside. We know rates have been parabolically moving to the downside. Fed funds rate has just been going lower and lower over time. So we're starting to see some sort of shift taking place. And now this is full circle. We're back to the most important part of this whole entire thing. And that is the percentage change, the annual inflation rate. Okay, so this is basically what we just got today. Now, this is not going to be updated because this is from the Fed funds data. So this is from December of 2021. But we know that our previous number was that 5.4% or 6.1%. There's tons of different ways that they calculate this, with or without, food and energy, and how they calculate housing and all this. None of that matters. What matters is the overall trend. So this says 5.4 right here. But in all actuality, if you look at the data that we just got, it's actually 7% is what was reported today for the CPI, which again is the consumer price index. So now when we look at this, going back to the 80s here, we see that around that time in 1990, late 80s, we see it peaked out about, roughly 5.2%, 6%, somewhere around there, roughly. Okay. And then we see in 2000 that it peaked out again right around here at roughly 3.3%. And that was that 2000 peak, the recession peak. This was a recession peak. And then we see right here in 2007, 2008, global financial crisis peak was right around like 4.5%. And then what happened then? Recession. And we see each time that we had basically been in this perpetual downtrend going to the downside. Here we actually threatened the previous high. So it started to look a little shaky, like, wait a minute, something might be changing here. But then we proceeded to put in a lower low. So we continued the downtrend. We didn't threaten the macro, but, came close to it, because now when we look at this, we see we have a high right here. Then we have a low right here. Then we have a lower high right here. Then we have a lower low right here. So while it looked like if you were looking at this too close based on just the recessions or based on this previous low or this high right there, you could say, oh my God, we just broke trend. That's it. Well, as soon as you start to break trend, you then have to look at the next part of the trend and then get like the big view on it. So while we came in danger of breaking trend, we then proceeded to go back down and essentially go to, a zero rate essentially on inflation. Or technically here in 2010, we actually went technically negative. So we had negative inflation. So, we had deflation. We had things costing less for a short period of time, based on obviously like this metric. So then here we see coming up to 2019, we had inflation starting to pick up, around, 2, 3, 4% right there. And then that was obviously the CVD dump that led into, the recession right there. And then it took us down. But when we came down this time, we put in a higher low. So now we have a low, and then we have, whatever you want to go by your high along the way. Technically this peak right here in 2019 was our high. And then we go and we put in a low. And when we put in that low, we put in a higher low. And then when we broke above that now and inflation started to skyrocket here, and again, it doesn't matter what it was because of. It doesn't matter if it was because of supply chain constraints. It doesn't matter if it was because of fiscal or monetary policy. It doesn't matter if it was because we turned off manufacturing or turned off shipping. It doesn't matter if it was because we put money into, the pockets of the people or the businesses. None of that matters. The cause, none of it matters. The data is what matters right now. And the data, the analysis is telling us now that we have a new high on this. So for the first time ever on this entire chart, going back to the 1980s, and we know for sure that prior to this time right here, what was happening in the 1980s, that was Paul Volcker raising the Fed funds rate to essentially like 20% to combat inflation. And then since that period of time, since the last time we ever had notable inflation, higher inflation, an issue with inflation, the last time that happened was in the 1970s. And then we combated it in the 1980s with a massively increased Fed funds rate that was like, 20% interest rate if you borrowed a house. Can you imagine borrowing a house and owing 20% per year on a 30-year fixed year mortgage or a 10-year fixed year mortgage with a 20% interest rate? No one would be able to afford anything. So what does it do? It shuts off the economy. No one borrows any money. No one does anything. No one creates any businesses. No one does anything. It literally shuts everything down. And that's how you stop inflation. Stop people from buying stuff because nobody has any money. Things are getting too expensive. Everybody's buying them because they're getting more expensive. We're going parabolic. It's like a short squeeze on goods. Everybody wants the goods because they're constantly just going up in price. So the second you get any money, you run out and you get the goods, you get the stuff, you buy the things because they're just always going to cost more in the future. So what does the Fed do? It makes money expensive. So by making money expensive, it shuts all the buying down. It shuts all the productivity down. It shuts everything down. And it combats the inflation and it stops it. So the last time that happened, the Fed had to raise rates to ridiculous levels to shut it off. And since then, we've never had inflation. We've never had a break of the trend since then. And now we have the first break of the trend. So for the first time in 40 years, something is different. So every other time when they tried to combat inflation, or I should say when they had to raise rates because of the stock market crashing or the economy was slowing or whatever, every other time when we ended up in a recession and they had to accommodate the interest rate and lower the interest rate to make money cheaper so that the economy could pick back up, so the stock market could continue up, so that businesses would continue to borrow and banks would continue to lend, that is different now. They were all in a downtrend that whole time. This is the first time we're seeing inflation. So this time, everybody says, well, no, they can't raise rates because every other time they tried to raise rates, the market started to crash, the economy started to slow, we ended up in a recession, and the Fed backed off. Jerome Powell tucked his tail between his legs, turned around, and he went home. Took the rate back down to zero, like the good little bitch that he is. So why would this time be different? Because we never had inflation any of those other times. And Powell is not dumb. He plays dumb. He acts dumb. He acts like he doesn't know what's going on. He says inflation is transitory. Everything's going to be fine. It's going to go away. We're good. Everything's gravy. The people are doing good. They have money. The economy is strong. The markets are strong. The trickle down, it's working. That's all bullshit. Okay. He's not dumb. He's one of the richest and smartest people in arguably one of the most powerful positions, not only in the United States, but in the world. He's not dumb. Arguably, the only reason he even went for another term is because he cares about this country, because he cares about the world, and he cares about his legacy. So he didn't want some socialist brainerd to take over as the Fed Reserve president, because he knew that she is brain dead and would probably cause irreparable amounts of damage to the world, the economy, and to the human race. Therefore, he stayed in position. Otherwise, he could just leave. The dude is worth hundreds and hundreds of millions of dollars, and he's old. And people know who he is. He doesn't want to be known who he is. No one knew who the Fed presidents were ever before. You could probably never tell anyone. People don't even know now who or what the Federal Reserve is or what the Fed president is or what their purpose is or anything about them. It's only now that we start talking about these people. So if he really didn't give a shit, he would have just left. He would have just said, F it, I'm going to Aruba and I'm just going to chillax, have fun. So we know that he stayed in position for a reason. We know that he knows what's going on. We know for a fact that he knows what needed to be done or needs to be done. We know that he was playing Dove, and that the second he was reappointed or nominated, that all of a sudden his view shifted. Now it was like, we're going to retire transitory. Inflation actually is out of control. We're a lot less concerned with equity and equality. We're not nearly as concerned about the unemployed women or Hispanics or blacks. Now we really got to focus on inflation. That was literally the opposite of what he's been saying this whole entire time. It's literally the opposite. He literally reversed everything he's been saying. So he basically was pandering to the left, and we know he's a Republican. He was pandering to the left, pandering to the Democrats, just long enough to get renominated, just long enough to get the votes, and now he's going to actually handle business. I mean, that's what I'm seeing. That's what he's literally telling us. And now when we look at the Fed dot plot, we're seeing anywhere from, 3 to 5 rate hikes next year, which is only 25 basis points, 0.25%. So we're basically at zero right now. We're at 0.07. So if we stop buying bonds, stop buying treasuries and mortgage-backed securities completely, which they've already said they're going to do by March. They're going to have tapered all their purchases, which is 120 billion per month, going to be at zero. And then they're going to start reducing the balance sheet now, which previously they weren't even talking about doing. So now they're going to talk about selling into the market to basically create more supply or, double up on before we were doing easing. So now not only are they doing less easing, but now they're actually tightening because they're making more bonds, more supply into the system or not purchasing them on top of it. And then on top of that, they're going to raise rates through too. So that's 3 steps in one direction. They went from literally all the way easiest to all the way lightest or hardest or whatever you want to call it, least easy. Now, 3 or 4 interest rate hikes is only going to take the Fed funds rate up 1%. Like four hikes is 1%. So, but going from basically 0 to 1% is a big deal. And everybody's afraid that's going to crash the markets. Oh, this is it. It's going to crash the markets. It's going to end everything. Well, let's look at our chart here. Where would 1% be on the chart? 1% would be right here where my cursor's at. It's probably tough to see, but it's right here. That's not even the danger zone. That's just another lower high. That's nothing. I wouldn't even be worried about that. What we have to worry about, what we have to pay attention to is once we get 6 rate hikes, really it's 7. Once we get 7 rate hikes. Well, no, actually, really, no, I'm sorry. Really, it would be, technically like 9 rate hikes is what we have to pay attention to, or 9 25 basis point hikes. So when we threaten that 2.38 level, that's basically at 0.25 basis points per hike. That's basically like 9 or 10 hikes at 0.25% per. But maybe he's going to have to go to 0.5. So that's what we have to pay attention to. Because the second we take this out, we can't go any lower. We were at 0 last time. We put in a lower high. We're at 0 again. So maybe we put in another lower high and we just come back down to 0. But this whole time, we never had inflation. This whole time, we never had inflation. Now the dollar's strengthening. Oil is breaking out. The dollar is breaking out. Inflation is breaking out. The last time the oil, the dollar, and inflation were breaking out was when Paul Volcker hiked rates to 20%. Do I think they're going to hike rates to 20%? No. But they're going to do something different here, something extreme, something unexpected that's probably going to crash the stock market. It's crash cryptocurrencies, crash housing market, crash everything in order to combat this issue that's going on right now, because they have to stop this from all culminating and exploding. Because once that inflation starts going, once it starts pumping, once it starts to the upside, it doesn't go away because people are already like entrenched. They're scared. They're worried. So that's what we have to pay attention to. So this next year, do I think we're going to get 3 rate hikes or 4 rate hikes, 5 rate hikes, like some of the bankers, big bankers are saying, that puts us at 1.5 rate hikes puts us at 1.33%. Another lower high. That will literally do nothing. I mean, it will help. It will help a little bit, but it will literally do nothing. I would not be surprised to see our next peak take out the 2.4 level. So does it happen in 2022? Does it happen in 2023, 24, 25? I honestly don't know. I can't predict the future. But I can look at the past and we can see this was in 1990, that peak. This was in 2000, so it was 10-year period. This was 2007, so about 7 years between. This was in 2019, so about 12 years between. So, roughly we're talking about like 10-year cycles. So sometime between, 2019 and 2029, I would expect the next peak to be. So, that gives us plenty of time. It's like a 7-year period that this cycle or this peak takes place. Maybe it's 5 years, maybe it's 3 years, maybe it's 12 years. We don't know that. But what we do know is that the likelihood, if they're going to actually stop this inflation and not go into basically a world death spiral, of inflation, and the dollar is going to completely wreck everyone, and interest rates are going to completely wreck everyone, and asset prices are going to go through the roof, inflation is going to go through the roof, all the poor and middle class people won't be able to afford food or anything. Well, they're going to have to raise rates. And they're going to have to probably raise them over 2.2%, because the reason Paul Volcker raised rates to 20% is because inflation was at 15 to 17%. So in order to stop the easy money, you have to raise the funds rate, well, technically the interest rate, not necessarily the funds rate as much, but kind of, yes. It has to at least be comparable to the inflation rate. So if we're currently getting reads of 7%, in order to actually combat that inflation, we need to have fund rates of roughly 7%, which means mortgage rates are going to be roughly 10%, which means, treasury yields are going to be, depending on the time duration or whatever, around 9% or whatever. So does it happen tomorrow? No, probably not. Is it going to be a slow and steady and well thought out process? Well, to some degree, probably. But it's going to get nasty. It's going to look like something that we haven't seen since the late 1970s or 1980s. This time is different. It's factual. We can see how all these things reacted in the past. We can see that oil is telling us something is different this time. We can see the dollar is telling us something is different this time. We can see that inflation is telling us something is different this time. So what are we waiting on? The Fed funds rate and the stock market, basically. Well, if the Fed funds rate starts going too high, or the treasury yields, start inverting again, the 2 and 10, or the stock market starts crashing, or any of those things in any particular order, well, probably what I'm saying is happening. And what do we see taking place right now? We see already yield curve inversion is taking place in other countries. And now, has anybody noticed that all of a sudden we're not talking about the 30-year treasury yield anymore? Now when you see charts all the time, you might see the 2, the 5, the 10, the 20, or the 2, the 5, the 10, the 30, but they don't ever put the 20 and the 30 on the same chart anymore. You don't see them in the same place anymore because the 20 and the 30 have already inverted. The rate on the 30-year is lower than the rate on the 20-year. Therefore, there's no reason for anyone to ever lock in a 30-year rate. And they're all negative. They're all negative real rates because of the inflation rate. So what happens next? Well, next, the 20 inverts with the 10. And then, potentially 10 inverts with the 5. Or, maybe the 2 and the 10 invert. And if you didn't see the video I did about the yield curve inversion between the 2 and the 10 and what happened every time that took place, well, you know what? I can go ahead and pull it up real quick, that same chart. So give me 1 second. Might as well make it thorough while we're here. So this is our 10 and 2 Treasury constant maturity. So essentially what it does is it just takes the 10-year and subtracts the 2-year. And then we see the zero line here in the middle in black. And every time it goes below the zero line, it means that the yield curve is inverted. So we see it took place here in 1980 and we went into a recession. We see it took place here in like 81, entered into a recession. We see it took place right here in 1990, recession. We see it took place again here in 99. That was the 2000 recession. We see it took place right here again in 2006. That was the 2008 recession. We see it took place here again in 2019. And when was that? CVD recession. So every time the yield curve inverts, we go into a recession. So this thing is now angled back to the downside aggressively. Again, we are looking like we're breaking trend right here. So we need to pay attention to all this stuff. There's a bunch of stuff screaming that this time actually is different. Like I always make fun of people when they say this time's different, but we are actually seeing that this time might really be different and we need to pay attention to it. So we're going to keep our eyes on all these different charts, and now we know the relationship of all of them and what they're telling us. We know exactly what Jerome Powell is telling us and the Federal Reserve. We know that they're planning to raise rates. They're going to stop their purchases and potentially start selling off their balance sheet, which is up to $8 trillion. It was like $4 trillion going into this. So are they going to sell down another $4 trillion back to where they started? Are they going to sell all 8? Are they going to sell 2? Who knows? They haven't said any of that. They don't like to quantify anything. But we know rate hikes are coming. We know that they're going to sell off assets off the balance sheet. We know they're going to stop purchasing assets. We know that things are at record valuations. We know there's record amounts of, speculation, rampant speculation taking place. We know that the dollar is going into a uptrend for the first time in 40 years, the DXY. We know that inflation broke out of a downtrend from 40 years. So it's worth paying attention to all these things, and all the people that are so sure 100% that there's no way they can raise rates because we can't pay for our debt and this, that, and the other. I talked about it in one video and I said, really, what is to stop the Treasury from issuing a 100-year bond at a fixed rate of, say, 2%, whatever they decide, 3%, 5%, whatever they want to do. And then they fund that with however many trillions of dollars they need. And then they lock that in. So they lock in a rate of, let's say, 3% for 50 years. And then Yellen gives Powell the nod, we're go. And then Powell gives Yellen the nod, we're go. And then they hike the Fed funds rate to 5%. 2.5% is all we need. Let's say they go to 5%. So they go to 7%. They go to 10% to stop the inflation. Does the government go bankrupt? No, they already borrowed all the money they need. They have it taken care of. They have a bond that doesn't mature for 50 years. So they have 50 years to pay that money back, and they're locked in at that same percentage rate. Maybe they double what they need. Maybe they need 30 trillion. Maybe they issue it in 50 trillion instead. I mean, there's so many different things that they could do. For all these people to speak in certainties and say they can't do it because it'll bankrupt the government. They can't do it because it'll bankrupt the country or the people, or everybody will be poor, or they'll be starving, or therefore inflation will run out of control. Therefore, we're going into a banana republic. Therefore, speculate on cryptocurrency or gold or silver or houses or stocks or whatever. Therefore, these are factual statements. But they're not. They're all wrong. None of those things are factual. None of them are grounded in fact. None of them take into account that we're seeing a change in trend for something that's been going on for 40 years. The problem is recency bias. People are looking at what has happened the previous 40 years while we've been in a perpetual downtrend of inflation, of rates, of the dollar, a perpetual uptrend in the stock market, a perpetual downtrend in energy. But this time is different. There's so many different things saying, excuse me, sir, what about this data? What about these factual numbers right here? What about the option of, the Treasury to issue a long duration bond? What about any of these things? But nobody talks about any of those things. Instead, they just write these little articles or read what somebody else said. They regurgitate it to each other. They stand around and, all just tell each other how smart they are and how rich they're going to be from speculating on trash or metals or whatever it is that they're like, real estate, stocks. This have to go to the moon because the Fed can't raise rates. They have to go to the moon because it would bankrupt the economy. It has to go to the moon because the people would suffer. So let's say they do crash the stock market and they raise rates. Let's say it does crash the housing market. Let's say that, everyone is starving and we go back into like Hooverville, Great Depression periods, and everybody's just struggling and it sucks and there's no jobs. There's no jobs being created. There's no money. Everybody's poor. They're getting defaulted on. There's nowhere to live. There's record numbers of poverty and starvation and homelessness. What's going to happen then? What's that going to look like? Are people going to be begging the government to do something? Are they going to be begging the rich and the powerful and the 1% or 0.1%? Please give us food. We will gladly accept your digital Fed coin currency. Please, just anything. Who cares? All we need is help. We can't do it on our own. I'll give you all my rights. You can implant a chip in me. Whatever the narrative is, whatever it is that they want, the perpetual like slave society. I promise, you can give me a infertility pill or injection or whatever, and I won't have any kids because I can't take care of myself. So I'm not responsible. Therefore, I'm not allowed to reproduce. Whatever it is, their agenda is. I don't know what it is. I only know what I've heard or read or the conspiracy theories or whatever. None of us do. But without any speculation at all, without any presumptions at all, we can literally just look at the data and tell 100% there is an alternative, and the Fed could and probably will be raising rates. And they're even sitting here and telling us, you will own nothing and you will be happy. Central bank digital currencies are coming. We are going to raise rates. We are going to stop the inflation. We are willing to, sacrifice jobs or equity or the economy if need be. So we don't need to speculate. We know for a fact what's going to happen. All we have to do is just use our brains and think outside the box of all the people that are sitting here telling us this has to happen, this is what's going to happen. But it's actually not. We have 40 years worth of data all pointing us in the opposite direction and telling us this time is different. And with that, I think that's pretty much my explanation of what's going on, what I think is going to happen, what I'm using actual data to determine what's going to happen, and looking at like the actual trends and everything. So we can take a short break. I'll answer some questions or, converse with you guys in the chat. Just because I'm going to snippet this later, though, I do want to remind you guys, this is not financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research and trade responsibly. None of this is meant to be buying or selling advice, tax advice, nor am I, saying that I think any of these conspiracies or theories or anything will come true into the future. I'm just looking at the data, analyzing it, and then, basically making educated guesses or conclusions based on that data. So, okay, so let me jump over here in the chat and see. So what's going on? Delhi says the Great Reset. Ty Smith says, okay, that was from earlier. Delhi says 1923 Germany, USA style. That's what's coming. Yeah, maybe. Educate me, bro. I love it. Would this force other countries to possibly accept a single world currency? Yeah, I mean, possibly, man. Possibly. I mean, it seems like the whole goal is to essentially at some point in time create like the quote unquote one world currency or whatever. And again, that might line up in the next decade after the dollar short squeeze with, what amounts to basically, the dollar no longer being the world reserve currency, some sort of like equality as far as like countries are concerned, because, obviously, being the world reserve currency gives you a huge advantage in many ways, but also cripples you in others. So it gives us a huge advantage that we get to export dollars and import goods. So we're not using up our natural resources. We're using up fake dollars, fiat currency, to buy other countries' natural resources. We're basically getting like this whole clean agenda thing going on here where we like, are basically like woke and we pay everybody a living wage and we treat employees right and we don't pollute. But then what do we really do? we just pay somebody else to do it. We just export like our, I don't know what you want to call them, our horrible policies or, reality. We export our reality to other countries and then we import the goods. So we basically have what? We pay like, Uyghur slaves in China to manufacture goods at like slave wages or in like concentration camps so they can like ship us iPhones, and we don't pollute the earth. We don't, pay people slave wages to make tennis shoes for us. So we feel good about ourselves. But in the end, is there a net difference? No. Somebody else is just doing our dirty work. We're just literally doing it out back in a shed where nobody can see it. But it doesn't change anything. We're one human race. We're like, so if us not paying people less money or us exporting our, poor decisions or whatever, whether it's pollution, whether it's, horrible things to like the human race or people within it, slave labor or, unfit conditions or polluting the earth or, not meeting like regulations or whatever. Sure, we're doing all that stuff. We're not doing it here. We're following all our rules. We're being nice and good people. And, we're just great. But meanwhile, somebody else is just doing it for us. We're just paying somebody else to do our dirty work. So like, we're not murderers. We're not polluters. We're not slave owners. But we're just paying somebody else to do it for us. And a lot of countries are doing that. I'm not saying it's just the United States, but at the same time, it's like, come on, like, are we just really acting like it's okay if somebody else does it, but like we're living up to our end? And then when we come to like these other emerging market economies and we're like, okay, everybody's got to have this new green, energy agenda. We can't do all this dirty stuff. And it's like, wait a minute, USA, like you had slaves, like you did all this bad stuff to get where you're at right now. You did pollution. You did these things. And now we're trying to come up too. We want to do these things. And it's like, no, that's not fair. And it's not just the USA. It's a lot of like the more developed countries are saying, you're not allowed to do this stuff anymore. And then other countries like, China just barely like trying to come up over these last couple decades. Now we have like India and Africa are trying to like come up and do stuff. It's like, well, why don't they get to take advantage of some of these situations? I'm not saying they should. I don't think there should be slavery. I don't think it's good to pollute the earth and, ruin the one earth that we have. I'm not saying those are good things. I'm just saying from their perspective, from other countries' perspectives, probably doesn't seem too fair. If now all of a sudden we impose all these pollution or mandatory regulations or, whatever on other countries that didn't have those same advantages that we did. So it's a weird situation. Edward says, what you're saying is true. He said, we are paying China to burn down the planet. Sure, 100%, dude. It's no matter how you look at it, I'm not saying it's just the USA, but no matter how you look at it, China's government, the Communist Party, is willing to say, hey, we don't really care about stealing your like property or digital information or proprietary like ways of doing things. We don't really care about certain groups of people or citizens if it furthers us as a whole. We don't really care about pollution, or we don't really care about, the cost of doing some of these things if it furthers us for the greater good as a country. And that's communism. That's fine. That's literally what it is. As where capitalism is like, we'll do all those same things, but we do them for money instead of the greater good of our people. So arguably, is capitalism bad? Sure. Is communism bad? Sure. Is one worse than the other? Sure. Which one is worse? They're both worse in different ways. It's all subjective. It depends how you want to look at it. Everything is subjective. Compare one to the other, and there's good things about one and bad things about the other. And somewhere in between, somewhere in that huge gray area is some solution or some truth that no one has been able to discover yet, or else everybody would just do that. If there was some great rosy picture where everybody was happy and the people all made tons of money and everyone's like, minimum living standard was great and the people did great and people made money and the world got better for it, whatever that is, sure. You discover it, write it down, turn it into a paper. You'll probably get the Nobel Peace Prize, and then everybody will just do that thing. But There's no thing. We don't know what it is. We know what it's not. We know what has failed in the past. We know what doesn't work. I don't think the Democrats know, but, the rest of the world knows. But regardless, there is no perfect answer. There's no, pretty sunshine and rainbows situation. So, but anyway, so that is the breakdown. Went into it obviously close to 2 hours. So that was quite a deep dive. But to tell you the truth, at this point in time, I hope I've answered a lot of questions for people. But the truth is, just that understanding of those few things that we just talked about is probably more than, I don't want to blow it up too much. Let's say you now understand probably more than arguably 95 to 98% of the population of Earth, of the world, human population, because I'm sure some of the aliens are probably, I'm just joking. But seriously though, you have probably a greater understanding than at least 95% of the world as far as how these things all line up with each other, what potentially could happen, and actual technicals, not just like speculations and opinions. So, I'm going to snippet that. I'll put it out later on in the week. I highly encourage you to share that with anyone that might be interested, friends, family members, whatever, or watch it a couple times. If you have any questions, obviously feel free to reach out to me. But just a base understanding of that and laying down a concrete, cement, solid foundation of that will give you exponentially more benefits into the future for understanding what is likely to happen, what is possible to happen. And when we hear these dominoes being set up and we start to see them fall in real time, even if we're not positioned ahead of time to get out of the way of that domino when it falls, we know at least what's about to happen. We know the chain of events and what's going to happen. So when they say things and we hear key words and it's like, whoa, they just said X. So that means probably Y is coming. Probably still got some time. But these things don't happen overnight. It's not like just tomorrow they say, okay, interest rates are now 10%. Everything crashes. There's a digital currency. Everybody has to come and get. No, this is like processes that happen over the next decade. But they've been building up to this over the last 40, 80, 100 years. So, hopefully that answered everybody's questions. Hopefully we got a greater understanding. I'm probably just going to do a shorter version of TA for the night as we are at about like the 2 hour mark. So, Crypto Deli says AOC knows the answer. She does. She knows exactly how to go to Florida, look like a complete hypocrite, and then get the coof. She knows exactly how to literally lose all credibility in a single weekend. Crypto Deli says, good stuff. Thank you, man. For sure, brother. That's what I'm here for, to help everyone understand and share my opinions, my knowledge, whatever. Edward says, they're going to crash this market into the wall. Thanks for the TA. Yeah, man. It's just like what happened with, the Great Depression, or, we had a series of, melt ups going on throughout the 1920s, the roaring 20s. Everybody got into the markets. All of a sudden we had, shoe shine boys and taxi drivers and housewives and movie stars and young people, the old people, everyone alike all of a sudden was in the market for the first time in their lives. And then next thing you know, we have a series of recessions. We had a Federal Reserve at the time. We had a bunch of stuff go on. And then what happened? We end up Hooverville, Great Depression. So does that sound an awful lot like literally what's happening right now? All of a sudden we have a bunch of young people investing in things like crypto and stocks and real estate. We have people levering up higher than they've ever been, which was arguably the reason that we ended up in the Great Depression, because it was like the creation of leverage. All of a sudden there's young people, old people, women, men, predominantly in the past. And don't take this the wrong way, but predominantly in the past, it was like rich white men are invested in the stock market and real estate and all this stuff. And now it's like, now there's so many women in it and everybody's teaching everybody about it. And all of a sudden there's all these, big talking points that are women or that are young that weren't even alive during 2000. And now they're telling everybody how to invest, how to manage their money, what to do. And now we have all kinds of, poor people and, different races, genders, any possible thing you can imagine. Every possible person is invested in these like assets, and typically levered up to the gills. Think about the whole Bitcoin situation. How many of these people that made tons of money in Bitcoin are like, oh, I'm not selling my Bitcoin. I'm just borrowing against it. I just borrow against it. So you're borrowing against it, taking no profits. So sure, you loan them your Bitcoin. They hold your Bitcoin at, let's say, 30 grand. Bitcoin runs up. You borrow 30 grand from them, or maybe they give you 15 grand. If the price drops too low, past whatever your leverage point is, or past whatever, your collateral is, they're going to just liquidate your Bitcoin. They're going to just keep your Bitcoin or sell it on the open market, pay off your debt, and now you don't owe them that money anymore, but your Bitcoin's gone. So for all the people that borrowed money on their collateral or staked their crypto or went through a company like BlockFi and loaned them their Bitcoin and borrowed money and then turned around and bought other cryptocurrencies, they're just levering up on levering up on levering up. The same way that people, take that money and buy a house with it. Well, sure, at least you have a house for it, but you borrow that money against your crypto. They liquidate your crypto. You bought a house with that money. The house goes down 50% in value. You lose your job. You don't have your Bitcoin anymore. You don't have any money. You don't have a job. And now you have to make a mortgage payment. You're upside down in your house. So you're going to turn around and sell your house and you're going to lose money on it. So now you're bankrupt. You lost your Bitcoin. You lost your house. You lost your job. I mean, that's literally the definition of like a margin call on life. And that's what I see setting up all over the place. So if ever there was a time to just protect yourself and be smart and not be over levering, in my opinion, this is it. It's not financial advice. I'm not your financial advisor. You do whatever you want to do. You go 100x long on Cum Rocket. That's up to you. You can do whatever you want. If you want to spend all your money on some shitcoin after a dog because Kim Kardashian has a fat ass and told you it was going to make you rich, by all means, go ahead and do it. Sure. Seems like a good idea to me. You want to, buy Tesla at $1,200 when their valuation is higher than all the other manufacturers, in the United States that make, 10 times the amount of cars in a world where we have an energy shortage. All the energy comes from coal and oil that makes all the stuff that is used for the clean energy, that makes the batteries, that makes the energy that charges the cars. Sure. That's all those things. That's up to you. But this really, really feels like 2008 or 2000 or one of these other, bubble bursts all over again. Maybe I'm wrong. But that's why right now I'm paying attention to the actual data and I'm not speculating the same way. Taking scalp trades, I'm watching moving averages, I'm watching, the technicals and what the charts are telling us, what the statistics, what the actual data is telling us. Not doing like reckless or stupid, ridiculous things with my money or with the health and future of my family. I do not think it's a good idea. But again, it's not my place to tell anybody what to or not to do. But so yeah, let's do a little bit of TA here, and we'll call it a wrap. So we're at about 2 hours now. So do somewhere between like 30 minutes to an hour of TA. Gonna kind of rush through some stuff here. So I'll definitely look at crypto. I will look at we'll look at the main indexes, and then probably just go from there. So see how we're looking on time. But I'm going to take a quick drink, so give me about 20 seconds. All right, let's keep on rolling, baby. If you're just tuning in, remember this is not financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research and trade responsibly. So obviously we saw on the 10-year Treasury, we have had something recently happen that caused all that extra pressure on the markets. And what that is obviously was the break of our local high. So we need to be very careful here. As obviously we're in a downtrend from back in 2018. We bottomed out right here at the bottom of the Rona dump, and now we're back on top of the daily 200 exponential and simple. we were paying close attention to this local or cycle high right here back from March of 2021. We obviously broke through the little like micro high right here, and we took out that macro high as well. So now we expect this continuation to happen, what we've been paying attention to and watching for some time. We have our cup and handle pattern playing out. We have our inverted head and shoulders, and now we have broken through the neckline. We expect our measured move to take us somewhere up near, stair stepping on our way up here. But, first 2%, then probably 2.5%, then potentially as high as like 3% short term. And that's on the 10-year treasury. So if we know right now it's at 1.7%, we know the Fed funds rate is basically at 0.08%. And we know they're talking about doing at least, Powell has said basically like 4 rate hikes. We see anywhere from like 3 to 5 on the Fed dot plot. So let's say 4 rate hikes, that's 1%. So if we're at 1.72% now, the Fed funds rate's at 0.08%, and they're going to add 1% to that. That'll take the Fed funds rate up to 1.08%, roughly, assuming that that's going to be correct. And then that will take basically this, assuming it goes up by the same amount, 1%, which it may go up more, may go up less, probably more though. That's going to put the 10-year treasury yield on the treasury notes at 2.7%. So that is basically our target. So would it be realistic to think that this happens over the next 12 months, over this year, according to what the Fed has basically come out and laid out completely for us? Based on what this chart's telling us, the measured move, the reversion to the mean, the touch of the resistance line on top, and also the moving averages, sure seems likely to me. And then when we zoom out even bigger, now all of a sudden, does it seem like maybe this could break out of this descending channel that we have been in? And you guys have seen this chart a million different times. But this is basically our perpetual downtrend for 40 years on the treasury yields. The initial break of the head and shoulders inverted, or cup and handle pattern takes us back up to the top, which is the red resistance line. If we turn off our drawing tools, just so happens to also be the 200 exponential and simple moving average. So we burst up to that. It acts as resistance. Maybe that happens over the next year. That's what 2022 does. We consolidate around for a few months, and then eventually into 2023, 2024, 2025, who knows? Inflation's out of control. Things are going crazy. We have weird stuff happening with the stock markets, with crypto, with the dollar. Who knows what's going on, geopolitically. There's hot wars, there's cold wars, there's, all this crazy stuff going on. And then what happens? We get the break of the actual downtrend, and then potentially like the measured move of our actual channel right here. And, where does that take us up to? Potentially somewhere up here, and like the measured move would take us to 5.6%. So maybe we don't make it that high. Maybe it's not that high. But if we do go to 5.6%, we take out our recent local high. We start putting in a new high. We start threatening previous highs. This lines up with, again, let's say roughly we're at 1.7 now. So if we subtract, the Fed funds rate and we figure that's about a 3% Fed funds rate. So is it unrealistic to think that the Fed sets the funds rate over the next couple of years at 2.5% or something like that? Is it unrealistic to think that we get 10 hikes or 5 basic 50 basis point hikes, and that takes us up on the 10-year treasury to like 5.6, 5.7%, somewhere around what, assuming inflation doesn't just stay at 7% or go up higher, maybe it comes back down to like 5 or 5.5%. So they combat it by raising this slightly above. Yeah, I mean, I think there's probably a path to this actually happening. It seems realistic to me. When we're looking at long time frames and using our brains, it seems pretty likely, honestly. So anyway, that's our 10-year. Let's go to, we're going to skip TLT. We already know what's going on with that. VIX is breaking back down, still in our neutral area. Nothing has changed. We're still right here in our neutral area. As long as we're between this dotted line and the horizontal dotted line, as long as we're above 14.95 and we're below 25, we're just oscillating inside a range. So, we're at basically support once again. There's moves happening in here, big percentage moves, whatever. But we know for a fact that when this happens, when we get the final break of this range, that is going to correspond with like a macro high or low in the stock market. We know that for a fact because this break right here was the COVID break into our red area. And this break right here into the green area, was basically like the 2017 area. Like these are like key areas when we have massive dumps in the market or volatility or whatever along the way. So as long as we're basically here kind of chopping around, sure, you could scalp, you can make some moves or whatever, but nothing has changed, especially not when we're literally in the neutral zone. But when we see a big spike to the downside, we know that's probably going to be a buying opportunity. When we see a big spike to the upside, it's probably going to be a selling opportunity. But reversed. So Dow Jones on the monthly. I'm going to flip this one over here. So while we're on the monthly, we know we're getting the hard sell signal. We're up at record high levels. We're basically in a complete melt up. We know on the weekly, we have lost momentum. We have, at this point in time, triple bearish divergence on the Dow Jones as we continue to just put in higher highs on price action and lower highs on the indicator oscillators. We know that the 8 and 21 are tightening up here, and eventually if we tighten too long, we potentially break. We also know that the reversion to the mean, the retest of the 200 exponential moving average, happens periodically over time. Seems impossible right now, but it's roughly around like 30,000, so would not be unrealistic to see like a 20% down move in this. Doesn't have to happen. Doesn't have to happen anytime soon. We're basically at highs, but again, daily bearish divergence on the Dow. This doesn't look like a great time to be entering to me right now, risk reward wise. S&P, so again, very similar, bearish divergence taking place between our price action indicator oscillators, looking pretty tired right here, reclaiming the 821, bearish divergence on the weekly as well. The Russell, so we came back down to our neckline or bounced the 200 exponential on simple, we're pushing back up here. We talked about a scenario like this happening where we actually get, I'm sorry, this is NASDAQ, I don't know why I said Russell. We're talking about this situation happening right here where instead of getting a horizontal line, head and shoulders, if this does decide to top out, where instead we actually get like a slope head and shoulders that's a little bit more like this, and then still a topping pattern, less symmetrical, but then we push up here, put in probably a double top or a slightly lower high with some divergence, and then we sell off. So that's still 100% viable. I prefer symmetrical patterns that are clear and identifiable because the likelihood of like one of the many other million people that are looking at the chart is much more likely if it's clear and clean and crisp. When it starts getting sloped and it's not symmetrical and it's kind of like, well, I kind of see a topping pattern, a lot of other people are going to miss it or not pay attention to it or not think it's valid, so it's less reliable. So that's what we're going for, is our edge, and our edge tells us there's a definite potential for a topping pattern here. The Russell has been range bound in this range forever. Man, sorry, I'm all stuffed. It's been range bound in this range forever, literally going back to basically January of 2021. So it literally went sideways for an entire year, did nothing, had one failed breakout, and now here we are back down at the bottom of the range. We have officially gotten rejected off the 200 exponential and simple. We have flipped the 200 exponential and simple over bearish. We're barely consolidating at the bottom of the range, looking more and more likely that we are actually going to break down from this. We have technically confirmed a bear market. We confirmed the bull market back here in November of 2020 at $1,534. We ran up to a high of $2,439, but we actually confirmed a bear market here at $2,215. So does it mean it has to just dump right here? No, but it means the easy trade was buy the bull market, sell the bear market. 41%. Easy peasy. Don't have to worry about nothing. Literally, the trend told us, buy here, sell here. No subjective, no, hey, I wonder if I should do this. Maybe we're not in a bear market. Maybe we are in a bull market. Should I scalp? Should I hold? Should I do whatever you want? But the indicator makes it so easy for us that we can do whatever we want inside of that. But the indicator says, hey, you want an easy 40%? Just do this. So confirmed in a bear market. The first of the major indexes to confirm in a bear market. Definitely notable. So XLE breaking out to the upside, as discussed, as expected. We talked about how energy would probably go parabolic, and that would be the peak in our, bull market basically. We have our trade setup still in play up to 45% here, and that's going to give us our target of 73.68. Obviously, that has been going on for a long time, but still paying attention to that. Looks even more likely than ever to happen as it's picking up momentum. XLI, again, just looking like it is topping out right here. It was trying to break out, but doesn't look great. Looks like it's starting to roll over. It's at resistance, though. If it chops around here long enough, it breaks the upside. If it chops around here long enough and can't break out, it breaks the downside. I know that's, well, of course, it either goes up or it goes down. Well, we're at resistance, so more likely than not, based on every other time we're at resistance, we got rejected. So my bias would be what's been happening happens again, so I think we're likely to get rejected. But it is possible we break out. If we just chop around here long enough, maybe it breaks out. XLB. So materials are basically, again, just at the top, chopping around here, getting a sell, putting in bearish divergence. Yeah, I mean, the bias has still got to be the downside. If we consolidate here long enough and start moving up, it's going to look good. But we did get a rejection candle. We're at resistance. We do still have a measured move play, though, to the upside for the remainder of the move to like 94. So maybe we push up to there and get rejected. Maybe we're already getting rejected. We have to really wait and see what happens. I mean, we're at like inflection point with a lot of this stuff. So XLF, financial sector, breaking out. We finally took out the 1.618 Fibonacci extension target. We are picking up momentum in the bullish control zone. Looks strong. And honestly, if the markets are doing good, financials are going to do good. If rates go up, financials are going to do good. So the two most likely scenarios right now are the market continues to go up or they raise rates. And then maybe the market goes up, maybe the market goes down. But I got to just say, I'm still biased to the upside on financials. Now, it is possible they raise rates and it crashes the markets and then, hurts financial sector. Definitely possible. But I think that's probably like a 1 in 3 chance right now. I think it's more likely that, if you have 3 possible outcomes, either stocks go up, financials go up, rates go up, stocks still go up, financials go up, or rates go up, stocks go down, financials go down. To me, that's 66% probability that financials continue to go up. So XLY, consumer discretionary, looks pretty toppy here. Came back down, retested support. We talked about this green and red line being a hard support, and then we actually hold the top of the descending broadening wedge as well. Looks tired. Looks real tired. This looks like we basically got a dead cat bounce, honestly. I think people were expecting the inflation print to be worse. So even though it was bad and the worst we've had in 40 years, it wasn't worse than what they expected. So they said, well, it's bad, but it's not worse than what we thought it was going to be because we expected it to be bad. Therefore, it's good. So buy the dip. XLP, consumer staples, again, looks strong, stronger than most. Looks a little bit tired up here, but has technically broken out and looks like it wants to hold support here and continue to the upside. But does definitely showing some signs of weakness. XLV, healthcare, so tagged our target to the upside, came back down, could not hold support. It did bounce perfectly, our triangle right here though. So if it chops around here long enough, I think it continues to the upside. Really don't like to see it below the yellow resistances, but it looks like it's just resetting right here and potentially going to continue to the upside. So healthcare actually looks pretty strong considering. XLU looks sort of toppy right here. Got to be careful of like a double top or head and shoulders scenario playing out. But overall, the key area to watch is just getting above that 70 level and holding it. If not, maybe it comes back down to the 200. We'll have to see. XLK, so tech basically came back down to that support. Dead cat bounced it, flipped the 8 and 21 back to the downside. I think this is getting ready to break. It's so hard for me to believe that tech is going to do good short to midterm here. Record valuations. Most of tech has just been getting absolutely crushed. Rates are about to go up. Like, balance sheet's about to get tapered. Asset purchase is about to get tapered. I just don't. It's so hard for me to put together a scenario where tech does well here. Um, and the technicals are telling us the same thing. I think this goes down to like 155. XLC communication still looks terrible, below 200 exponential. 200 simple is basically flat right here. We came up, we got rejected, and it looks like it wants to roll over. If we take out 73.86, we probably go down to 71. That's also the 236, and then we continue to the downside after stair stepping. If we take out 80 to the upside, we probably reclaim this level and then maybe retest the highs. I think bearish though. XLRE real estate obviously had a pretty aggressive sell-off here. Again, we're seeing now like new housing and home builders demand falling. We're seeing lumber prices going back up, which is going to mean housing prices and building is going to be less of it, or it's going to be more expensive. We're seeing rates going up already, the highest rates we've had in, I think they said like 2 or 3 years for mortgages now. We're seeing all these conditions like go away where basically like squatters were just living in someone's house, not paying them rent for years. So supply is probably going to come on the market. Rates are probably going to go up, so people are going to be able to afford less house. There's going to be more houses for sale. Less people are going to be buying houses. Therefore, I would think probably prices are going to come down. Now, I know a lot of people are saying, no, that'll never happen. Rates are all-time high, so people will just come in, they'll buy the houses, they'll rent them out. Maybe. It'll definitely happen slow, and it will be a grind. But the reason that real estate is dangerous is because once the trend does turn, there's no liquidity. You can't just log into your, account and sell your house. You have to like find a buyer, get somebody like actually, it's like a whole month plus process. So, and if you're thinking it, probably other people are thinking it too. Therefore, now the buyers have the advantage for the first time in years. So then people are like, well, I'll just wait now. If prices are coming down, I'm not just going to buy right away. I'll wait till they keep coming down. I don't think it's going to be like a perma bull buy the dip scenario like we see on stocks. Maybe it will be though. I don't know. Depends where you live probably too. XTN transportation looking pretty toppy right here. Definitely rolling over. Back below the resistance. Hanging on to 200 exponential and simple for now. If we consolidate here long enough, I mean, whatever direction we get the break in, it's going to be aggressive, but I'm still bearish on this. This is around the time I think where this tops out. It does not look good to me. Cyclically or like honestly, like secularly. Hail looks bad. We're at support. Basically broke down, failed to break out. Coming back down, officially in a bear market below the 200 exponential and simple, according to the TJD Master. Jets looks terrible, 200 exponential and simple. We all know the Rona's never going away. International travel is not going to come back. You're going to need to get a passport, plus a cough passport, plus flights are going to be more expensive, plus business travel is going to be down because everybody's like Zooming. I mean, breaking down from support. This chart topped out in 2014. Now it does not seem like a good idea to invest in airplanes, in my opinion. Maybe like a VTOL, okay? If somebody has a VTOL for sale, or if there's like a VTOL stock, I'll probably buy that. That's like vertical takeoff and landing. I think that's probably the future. And I'm not talking about some electric BS. I'm talking about a big, juicy diesel VTOL, like the ones you see in movies / the military using. I'll invest in that. Because that's how we're going to be transporting stuff. If the world starts getting as ugly as I think, it's probably going to be where we want our money at. If we're going to invest in things that fly, they're probably going to be things that fly and make other things go boom. UPS, looking pretty toppy right here. Again, at resistance. Cyclically, looks tired. Hard sell signal. Bearish divergence. Looks tired. FedEx looks like trash. Bear market. It's trying to reclaim the 200 exponential for right now, but this just is massively underperforming. And we know the last 2 times we saw this take place, this thing had a massive, massive hit. And each time it happened, it was from the top of our broadening wedge or megaphone pattern. And each time we came back down and touched the bottom. So if this thing does take a hit, there's a lot of room to run to the downside. So Pave. Again, smacking our head on that resistance. Bearish divergence. Got to be careful with this guy right here. Looks real tired too. But the infrastructure. Let's look at some crypto. Bitcoin futures. So we rolled over below the 200 exponential and simple. We have officially confirmed the bear market. They're both angled to the downside. Now you hear everybody's talking about the death cross, but it doesn't have to be the end. It could go into a golden cross. This could be the bottom. Buy the dip. 4-year cycle's not over. Lengthening cycles. But they can say whatever they want, okay? This indicator has not been wrong. If you bought it when it said bullish, that was at 9,000. If you sold it when it said bearish, that was at 47,000. So, and all the other stuff in the middle was just noise. You could have done whatever else you want along the way. I like those odds. 9,000 to 40,000, 47,000. That seems pretty clear cut to me. So if this changes, if we get back on top of it, we continue to the upside, that's great. I will gladly admit that we are back into a bull market. But we know for a fact that in order for a bear market to confirm and happen, every time a bear market happens, this exact signature happens. We go under the 200 exponential on simple. They flip over red and pink accordingly. And then we see 80+% downside potential. So I'll probably just stick with that. And then if we get back on top of it, we rally back up, we flip slopes back to the upside, I will gladly buy back in at a higher price with much less risk. But at any time, we could literally just see, one of those 10, 20% days to the downside. Those capitulations. Or to the upside. It's possible, for sure. Bitcoin Bitstamp chart. Again, we have rolled over the 200 exponential. 200 simple has technically been saved right here. We did get a false signal on this one time. We didn't get it on futures. We did get it on spot. So, but even then, we were able to capitalize on triple bearish divergence, triple bullish divergence, and now here again, bearish divergence. So I'm going to stick to what I'm doing here. We are getting the hard buy signal. But again, now that we're technically under the 200 exponentials and it's looking more likely, 200 moving averages, it's looking more likely like we're entering into a bear market. Instead of buying the dip, I'm looking to be selling the rip. So I'm taking profits early and often on my scalp trades. Now, everybody in the group knows I am, full disclosure, not financial advice, I am still long Bitcoin and Ethereum for now. But I will literally take profits on those positions in a heartbeat because I refuse to give this up. But we had talked about specifically how we were looking for this candle right here, this exact candle, and we finally got it. So what is this candle? Well, it's basically a nail or a hammer, whatever you want to call it. We basically get rejection of lower prices. Price action sells off to a new low. People swoop in and buy it back up. That is a rejection of lower prices. A bottoming pattern, the same way that a shooting star is a bottoming candle, same way a shooting star is a topping candle, corresponded with some exhaustion in the bearish control zone, some bullish divergence. We have a low right here, a low right here. We have a much higher low on the indicator oscillator, much lower low on price action. So that is obviously bullish divergence. So based on this candle rejection, based on the bullish divergence, we took a couple little swings / scalp trades to the upside. Around like 40,000 real time in the group. I told you guys I was looking for it way ahead of time, and then obviously it happened. With little scalp trades and stuff like this, where I don't know how long they're gonna last for. I'm not posting big elaborate like trade setups or whatever. I'm more doing that for like swing trades and stuff like that, and they're to learn, not for you to just follow whatever I do, because obviously this is not financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research and trade responsibly, or else you'll lose all your fucking money. Ethereum broke below 200 exponential. It has rolled over. We broke out of our channel. We were in this massive channel to the upside the entire bull run. We broke out of that. So this is by far the most bearish Ethereum has ever looked. We were looking for a target to the upside of 200 exponential and simple, but we will see that actually the way Ethereum is playing out right here, the 200 exponential and simple on the 4 hour are actually higher up. So I think we're less likely to actually hit the 4 hour target and more likely to get exhausted on the daily target. So I will probably take at least part of my position off here, or if we start to break back up below, the 8. Not seeing that same bullish divergence either on Ethereum. So not looking great. And then we see the Ethereum Bitcoin chart, broke down, got the measure move almost to the T, came down back inside the range, trying to reclaim it. All right, what's Ethereum going to do in relation to Bitcoin? Could go either way here. Could go either way here. Inflection point, and it's not really giving us anything one way or the other. I do not know. But obviously, that corresponds with my trade also because I'm in both Bitcoin and Ethereum. If I saw something clearly telling me be in Bitcoin, not Ethereum, I would be in Bitcoin, not Ethereum, and then vice versa. But instead, I'm in both of them. Not really in shitcoins right now, though. My trailing stop took me out of that chain link position with some very nice gains. I had a couple other little like random shitcoin like little scalps, but nothing of note. More like just stupid money to play with. Nothing that's going to make me retire and disappear tomorrow by any means. So don't worry, guys. I'll be back on Sunday. So our weekly crypto market cap. So we have bearish divergence between our two highs right here. We have hard sell signal left the bullish control zone. Hard sell signal left the bullish control zone. We have the 8 and 21 getting ready to cross the downside on the weekly. We have a clear lower low. We took out the previous weekly low with that candle close right there as well. So, well, we're basically at it. So if we break down from here, there's basically no support until that level we've been paying attention to, 1.6 trillion. So get ready to lose another 400 billion. We already lost 400 billion from right here to where we're at now. It's another 400 billion. What's 400 billion between friends? And then after that, our target is 1.2 trillion. So that would be another 800 billion to the downside. So looks terrible. This looks terrible. Crypto cap looks terrible. Looks like bear markets all over the place. Bitcoin dominance. So we're paying attention to obviously our triple bullish divergence on Bitcoin dominance. 1 drive, 2 drives, 3 drives, 1 drive, 2 drive, 3 drive. We did invalidate that drive on the Jewel Thief, but it is still very much present on the TJD TDMACD. And it looks like we're trying to carve out a bottom here. So the areas to watch are if we break out of this support, obviously alts are probably running and Bitcoin's getting crushed or not running as high while alts go parabolic and cum rockets are busting all over people's faces. Or we move back up to the top of the range, which is roughly 45, at which point in time we have to pay attention to, do we break out of this range and get the measure move to retest the 200 exponential and simple. But yeah, that's right around like that 45 level. So below 40, it starts to get sketchy. Above 45 probably is going parabolic compared to altcoins. So Chainlink trade obviously played out nicely. It was like between 20 and 50% depending where we entered. We were looking for a little more upside, but unfortunately came back down and took us out of our trailing stop loss when it lost that 0.5 level. Not a problem though, because we literally just turned that around and put that into Bitcoin and Ethereum, and then Bitcoin and Ethereum have been running while Chainlink literally has done nothing. Because over the last 3 days, we see Chainlink has literally done nothing, and in the meantime, Ethereum and Bitcoin have ran like 7 to 10%. So beautiful. We just get in position ahead of time, ride it up, and then get out of the way. If this stays above 200 exponential and simple long enough, we'll start looking pretty good. But I have a feeling that this was just a little liquidity event run up, and this will go back to being just another shitcoin that no one cares about. But I do like Chainlink though. Don't get me wrong. Polkadot very clearly in a bear market. The 200 simple still technically has a slope to the upside, but we are below it and it looks weak. We did put in a slightly lower low on the daily. We do have some daily bullish divergence between our indicator oscillators and that low right there. So maybe we push back up here. It's going to be very difficult to get above $30 though. So could have another 10% move to the upside though. But it doesn't look good. None of these look good. Uniswap, just hanging out at the bottom of the range. Maybe it pushes up to the top of the range. I don't know. It does not look particularly great. Does not look particularly great. Yeah, I mean, target to the upside potentially like $20 to $21. Support basically at like $14. Trying to pick up some momentum. There's nothing really there though. XRP looks terrible, barely holding on to support. Downside target still 52 cents. Basically crossing into the bear market. Maybe it retests like 92 cents if it gets above there. possibly like $1.12. But I mean, this is the worst crypto that we look at regularly, based on volatility and based on momentum and based on like if you traded anything else for the last like year, you made more money. Manic. So reclaim our little channel back on top of the 200 exponential and simple, holding strong for now, looking okay. I did not end up taking this trade, but there was a nice momentum trade with a potential like 33% target to the upside. So, I mean, is there an actual trade setup from here? I mean, there's still such a freaking juicy setup. I mean, technically, if you wanted to be responsible, you would say if we put in a new swing low, you want to be out of the trade, and your target is the top of the range. So that's 21% with the 17% stop loss. So that's not feasible or viable or really tradable. So instead, we tighten it up. If we lose the 200 exponential and simple, which we're currently holding, break down below them on a daily time frame and close, which is only 3% below us. So it's tight like a tiger with a 22% target to the upside. That's like a 6.6 to 1 risk reward ratio. So we'll see what happens. Maybe we get a better entry, but if this starts to hold and we start to see a little momentum, could be good. Now, do I think that's going to happen? I mean, it looks like it wants to roll over. It looks like we're about to get the hard sell signal and exit the bullish control zone. We're seeing multiple red histograms. So again, what we want to see here to enter this trade, I want to see a push down. I want to see one of these key levels hold, either the support of the channel or the 786 of the Fibonacci. And then I want to see a rejection of lower prices. And the way that looks is a big old wick gets bought up aggressively to the upside. And then that's where I want to enter at into momentum for this 20% move. So, but maybe I buy it on the way down, but it's much more risky to buy it when it's selling off versus once everybody steps in and says, we're not going lower, bitch. So BAT, basic attention token, again, reclaiming that key support level, hanging on for now. These look like dead cat bounces to me, or like retests of the breakdown levels. So I don't want to get particularly bullish on these things. The time to get bullish was before we had these run-ups. And we're confirming like into bear markets or possible like transition territories. So not the greatest time to just be like going long and trying to capture those last gains, in my opinion. Cardano, go figure, still looks terrible. Still looks like total trash. Charles Hoskinson is still a bitch. Total garbage. Total garbage. Bounce back up to $1.30. Retest that resistance as we had discussed. The white line resistance. Also the top of our descending red line here as well. So nice little move. 20% maybe. Nice little move. But constantly just putting in lower highs and lower lows. Terrible. Terrible. Sushi, rejected off 200 exponential and simple, failed to save the 821, came back up for the retest, and now it looks like it's getting rejected. This thing looks like it just has further downside. Probably comes down here to $6 and probably $5.12 after that. I don't remember who asked me to look at this, but I'll look at it a couple more times, but you should be way out of it by now. We already know this was the time to get out of it. Well, I would be way out of it. You can do whatever you want. Obviously. Hathor. Again, just really topping out here. Coming back down to 200 exponential. Retesting. I mean, it looks like it's going to try to push up here again. Probably does another similar thing and just comes back up and retests it. Is that tradable? I mean, it's like a 50% range. But, it could be 50% to the upside or it breaks down rug pull. So, could go either way. I don't know anything about this. I literally just know someone asked me to look at it. So, but you could argue it's like a 3-to-1 risk reward. I mean, I would rather just buy the 200 exponential or simple though. If I was going to grab something up right here, I'd be looking to grab it up around this area with a stop below that previous swing low and a target of anywhere from resistance to, just a retest to the top of the range. So tradable range, 18% stop loss, 77% upside. I would not hesitate to take profits though. And that might be, it's probably a risky trade, but the risk reward is there if you can get the entry on it. But I wouldn't just FOMO into it, honestly. Avalanche, broke down from the 821, retesting it. Looks like it wants to cross back up, put in the hard buy, a couple grain histograms. Does it succeed or does it fail? Could go either way here. Could go either way. If we close back above $100, I think it rallies back up to a lower high. If we do not close above $100, I think it goes lower. So right now, target to downside is like 79. Target to the upside, well, once we get above $100, we can start looking at targets to the upside. But realistically, I mean, 115 doesn't look great. Doesn't look terrible though either. It doesn't look great. So Solana came all the way down to 200 exponential and simple. Hard buy signal out of the bearish control zone. Trying to push back up here. Starting to look like a descending, broadening wedge more than anything. Let's clear this off here and start with a little freshness. Got a little something going on like this. It's not a great way to put it. You have at least 2 touches there, a couple little wicks. I kind of like that. Not much we can do with this top here. Something like this probably. Maybe if we went to the weekly, it would look a little more like clear cut, but I think something like that is probably what we'd be paying attention to. So if it bounces this, comes back up, it probably bounces back to resistance around like 173. If we get the break to the upside, which technically this is more often than not a bullish pattern, the break probably takes us somewhere back to around like 230. Wouldn't get overly excited to jump into this one. I would wait for confirmation, and it's likely to underperform. We're below resistance now as well, like failed support. So 200 exponential holding for now. Could go either way though. Could go either way. MicroStrategy looks terrible. Came back down, tagged our target, getting a little dead cat bounce off of Bitcoin's move. Already hit the 382. Next target is 411 or possibly 351 to the downside. Could very easily come back up and retest 615, which is like a 20% move to the upside. Definitely possible. Putting in a little bit of bullish divergence here, potentially. So, I don't know. Really want to see this cross to 821 back up. Probably does come back and retest like 615 though. But obviously I'm not trading it because Michael Saylor is a bitch. Hood, lowest low that ever load. A little bit of a bounce. Again, some bullish divergence. Is this like the bottom though? Is this the bottom? I don't know. It's way too early to tell. Eventually it will bottom though, and there'll be a nice trade to the upside. But we got to just wait for it to show up before we take this. Coinbase broke down from support, came back up, retested it. It's acting as resistance. Looks like a rejection for now. Man, this thing really looks like it wants to retest the lows. So I would not be surprised to see this at like $210 or $206. If it reclaims this area, Bitcoin stays strong, and it starts creeping back up, I will probably enter into this momentum trade. But it really has to reclaim this area before I get interested in it. And a little bit of consolidation, not just like a quick little pump up and then a failure. Bed Bath & Beyond is in fact trash, closing a bunch of stores, new lows, probably going away. I mean, we're done with this thing. We literally held this down and had our Bed Bath & Beyond with it. And now the scented candles have gone out. The springs in the bed are wore down. And it's closing time. We can't find our sweet, sweet remote. AMC looks terrible. A little bit of, oh no, it doesn't even have divergence. No, it just looks so terrible. Below 200 exponential and simple. This thing looks like it's ready to go into a bear market. You monkeys better be selling off your little AMC stocks. I don't care what you do, but you're going to have a real shitty life living with your mom in the basement, thinking about all the AMCs that you could have sold And instead, you're doing dishes, eating baked chicken nuggets that your mom made for you, hoping that she dies so you can have your own house. Now, that's terrible, but probably true. GameStop, GME, again, trash. Bear market confirmed. 200 exponential and simple have rolled over. Targets to downside are much lower. Obviously, we have them here at $100, but realistically, this thing will be at $67 very soon. Such a trash bag stock. Fake company. I mean, it's a real company, but its value is fake for sure. DraftKings looks like trash as well. Broke down from support. Needs to at least reclaim $29 before it's of any use to me. Other than that, probably goes to $18.50. All right. So we did a deep dive today on like the macro outlook and everything going on. Hopefully you guys got some value out of that. Definitely a solid foundation to build your thesis, and also, you know, lots of dominoes identified. So if they should start to fall, we can position ourselves or at least get the hell out of the way of them. Gold still doing nothing, just kind of consolidating. Obviously, the weakness in the dollar and the weakness in the treasury yield is good for gold because that is its two main headwinds. And also a high inflation print is good for gold as well. So if inflation fears are good for gold, treasury yields coming down are good for gold, and weakness in the DXY is good for gold. So those three things all in gold's favor, and it went up, what, $44. Hooray! So not exactly getting excited about that. But I'm not saying I hate gold. Have lots of gold. Have lots of silver. I love gold. It's awesome. It's fun. It's colorful. It's heavy. It makes awesome sounds when you bang things up against it. But the truth is, it's hard for me to get bullish on gold here. I'm just not seeing it, guys. Just not seeing it. Silver barely hanging on to support. Barely reclaimed support again. If this thing breaks down, teens. If it consolidates here long enough and breaks through this level, though, I really do think it retests like $24 to like $25. So maybe a paper trade is in the works here, but I'm not trying to accumulate any more physical silver at these prices, especially not while the gold-silver ratio is much more favorable to gold. So, but I'm not going to do all the commodities and tech and everything today. Everybody knows we had some dead cat bounces. We had some nice little pushes up in energy. Banks look strong. Most tech stuff still looks absolutely terrible, but had, you know, decent little bounce. Plot stocks, we had a couple little bounces on. I told you guys I've been just kind of dipping my toes in the pot stocks. I do have small positions in some of them, but I will not hesitate to take profits on scalps. But I really am looking for like value accumulations on them at these levels. Same with miners as well. If gold and silver start to strengthen and inflation keeps coming on strong, dollar keeps weakening, treasury keeps weakening, I will probably reposition myself in the miners, buying into momentum. But I don't think that's likely to happen here. So we will have to wait and see. But that's going to do it for tonight, guys. I'm going to jump in the comments here. And then, what's up, Crypto Galt? Hey, brother, just joined. Headed to the start for a rewind. Yep, enjoy it, my man. Upgraded my account from bot to thought by request. Hopefully we'll trigger a trend for you. Yeah, I appreciate that. Dude, you know what is crazy? No bots showed up today. So somewhere in the bot AI, they decided that they no longer want to participate. Or they have showed up so many times, and I have banned them so many times that I have literally banned the last bot on Earth, and there's no more bots left. I have outbotted the bots. I botted the thoughts and thoughted the bots, and now there's no more of any. News from above said, I'm so blessed to have found your channel. Good to see you, my dude. I appreciate that. Thank you for the kind words. Glad to have you. If you're looking to learn and, you know, build up your skill, this is the place to be, man. This is the place to be. I don't know what your level of knowledge or experiences is, but I literally have put out hundreds and hundreds of videos, thousands of hours, all kinds of different tutorials, live streams, and I literally have done countless amounts of technical and fundamental analysis. So dive deep into the videos. You can learn how to use the indicators. You can learn how to do all this stuff. I'm very consistent in the way that I trade and do technical analysis. So the more time you put in, the more you will gain from it. So glad to have you. Appreciate you participating in the chat and your kind words as well. To anybody out there that did not say something today but is listening, I appreciate you being here as well. To all the group members, thank you all for your support. I am much appreciative of it, as you guys are basically what allows me to dedicate so much time and effort to putting out this content for the community. So thank you all for your support, and hopefully you're all enjoying the indicators. I know the new Jewel Thief is working phenomenally, and the Master is by far my favorite indicator of all time. And last but not least, Crypto Deli said, gonna get a hold of you about your group. Thanks again. Hey, yeah, for sure, man. Definitely be glad to have you, brother. Appreciate you participating so much. And there is plenty to learn. And, you know, it's nice to have the real-time interaction with you guys as well. Not only for your own selves, but for me. And to tell you the truth, man, the group members can attest for it themselves. I can literally see them growing. Some of them are relatively new. Some have been with me for, you know, years at this point in time, and I can see improvements in the technical analysis, their trading, trade setups, overall knowledge of the markets. And the truth is, you build a solid foundation, you spend a little time and a little money doing this, and it will literally, you know, reap rewards for the rest of your life. So I think most people are looking for financial independence, and while I cannot guarantee that, I cannot promise that, you get what you put in, but I'm more than willing to share all the tools at my disposal, the knowledge, and you know, hopefully help you to get there. But you know, obviously this is not financial advice. I'm not your financial advisor. These markets are extremely volatile. Please do your own research and trade responsibly, and make sure you guys are in it to win it for our Sunday night live stream. I go live every Wednesday and Sunday from 8 p.m. till roughly 11 p.m. Eastern Standard Time. But you know, I'll put out that snippet for this video earlier as well, and always put out like some short little snippets during the week. But the real technical analysis happens on the weekends and in the trade group. So that's it for tonight, guys. Appreciate each and every one of you tuning in. Make sure you smash up the like button, share it with your friends, help other people to learn about what's happening in these markets, and prepare yourself. Love your family, love your dog. Cats are meh. You know, give them what they give you. That's what I'll say about cats. But that's it for tonight. It is Wednesday, January 12th, 2022 at 10:51 p.m. Eastern Standard Time. That's a nice little TA, nice little breakdown. That's Crypto Trend Trader, and I'm out of here.